school, and I actually have enough credits to graduate with the business degree right now.
I think I really want to mention just that I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
I want other people and parents to know that the home visiting is not something that you should be afraid of. It's actually something that is needed.
You know, because she's not just here for her, she's here to help with all of it. She helped me create a safe space where I feel comfortable enough to ask for help.
Don't be afraid to take that step. Like, don't be afraid to get help. It's always okay to have extra support.
I would say, give it a try. You got nothing to lose. It's free. There's some perks, you know. They've got great resources.
Personally, I think everybody could benefit from the home visiting programs.
I realized that my life was going to change dramatically in ways that I did not know or understand or even comprehend. I was going to have to really go to the well and become accountable and adjust to a lot of things differently.
Lo que queríamos era que naciera, ya, sí, ya quiero tener, entonces ahorita lo que tenemos es aprovecharla, quererla y cuidarla lo más que se pueda.
Creo que a todos nos preocupa la primera vez que nos dicen que vamos a ser padres.
When we started the program, my daughter was about 3 months, and my daughter's 22 months now. Something I love about my child, that she's healthy, she's happy, she knows that she's cared for and loved. Those are some of the things that I wanted to make sure that she had, and she has them.
I'm happy today with my daughter. She's the greatest thing in my life, and I'm glad to wake up and see her, and everything I do it for her.
Sí, bueno, yo también vengo de una familia separada. Creo que por eso también me motiva a estar más presente con él, de quizás también estar de la forma quizás que yo no la tuve para Máximo, y también comprender que el padre no solo es el que pone los límites y las reglas, sino que también está ahí para hablar, acompañar, regalonear, jugar, cosas lindas también, no solo ser el guía para el niño, sino que también un compañero de vida.
I was more of a elated and thankful, because for 3 months I was in baby land. And when you're in baby world, you're just kind of flying by the seat of your pants and hoping you know that you're just supportive in the ways that you can be supportive.
Pero pues aquí pues ya los
Richard, would you like to lead us in the Pledge of Allegiance?
cuidarla, cómo desarrollarla, cómo educarla, y pues es algo
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, God, indivisible, liberty, all. Okay, the Mendocino County Board of Retirement meeting for August 21st, 2014 is called to order at 8:31. Members of the public are welcome to address the board on subjects both on and off the agenda. Do we have any members of the public wishing to make comments?
There is no public comment. May I take roll call?
Yes, roll call, please.
Mr. Kelly? Ms. Cavness?
Here.
Mr. Jurdy?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker? Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Pierce?
Here.
Mr. Land?
Here.
All present.
Okay, all matters of the consent agenda are to be approved by one action without discussion unless a board member requires separate action on a specific item. Does any trustee wish to pull an item from the consent agenda? The consent agenda is approved by unanimous consent. We are going to go toward the item number 2, historical benefit review, project status report, and project updates. Executive Director Rentschler.
The report for the correction project shows that an additional 6 corrections were processed during July. And if you have any questions regarding the project, I'd be happy to answer any questions you have regarding it.
Is there, do we have any member discussion? Is there any public comment?
There's no public comment.
Okay, then we will move on to investment matters. Presenters Greg DeForest, Hannah Vera, John Perrone, and Claire Telline of Callan, and Robert Reveles. Welcome.
All right. So Hannah is virtual today, and I'm joined by my colleague John Perrone, who's a member of our capital markets research team. And we've got a couple topics that we're going to talk about today. The first is performance for the plan as of the end of the second quarter, so looking at performance through June. And then the second item, which I think will be kind of the bulk of the discussion today, is looking at your international equity structure, the implementation of your international equity asset allocation. John's taken the lead on that study, so he's going to do a lot of the talking there, and that's where I think we may have some action items out of the committee, some potential direction for our next discussion. We're going to start with performance. So I mentioned that Hannah's on the line. She is going to kick off with a quick overview of the capital markets as of the end of June for context of the performance that we saw for your plan. And then I'll walk through performance and asset allocation of the plan before we shift gears to look more specifically at international equity. Any questions before we dive in? Okay. Hannah, I'll turn it to you.
Okay, great. Can everyone hear me okay? All right, starting on slide 3. So second quarter performance was mixed across asset classes. Taking a look back throughout the quarter, stocks lost ground in April as investors struggled with mixed economic news and mixed signals from the Fed. Markets turned in May, however, rallying around upbeat Q1 corporate reports and signs that the economy remained strong. This momentum, along with news that inflation rose less than expected in May, bolstered investor sentiment. Enthusiasm was tempered, however, following the Fed's policy meeting in June, in which only 1 rate cut for the year was penciled in, versus the 3 previously communicated in March. Markets have taken the higher for longer mantra in stride, with bonds down modestly year to date, and most stock indices up, albeit with much dispersion. A lot of the themes from the first quarter have continued: strength in equities, while rate-sensitive assets like fixed income and real estate struggled. The S&P 500 index climbed 4.3% for the quarter, and it's up almost 25% for the trailing year. Index returns continue to be driven by a handful of stocks, especially the Magnificent Seven, which comprised 33% of the S&P 500 as of quarter end. Within equities, emerging markets and non-U.S. small cap also posted gains, while U.S. small cap and developed U.S. stocks fell. U.S. small caps, as measured by the Russell 2000 index, were the worst performers for the quarter, down over 3%, while emerging markets were the strongest, up 5%, led by China and India. We saw this in the MSARA portfolio as well, with our EM fund up almost 7% and both small cap funds down 3 to 4%. Fixed income was about flat for the quarter. The Bloomberg Ag Index was up 7 basis points despite rising rates due to coupon income offsetting price losses over the quarter. Real estate saw negative appreciation once again, although strong income returns. And then inflation, measured by CPIU, continued to tick downwards, coming in at just under 3% for the trailing year, down from 3.5% when we looked at this last quarter, improving the prospects of a rate cut later this year. On the next slide, we can take a look at some more economic data. Overall, the economy continued to chug along in 2Q as real GDP came in higher at 2.8%. Inflation trended downward year over year, down sharply from previous year's highs, but remains above the 2% target. The labor market remained resilient. Strong April jobs report and sticky inflation readings initially drove the intermediate and long-term rates higher, sending the 10-year Treasury 50 basis points higher and reducing the 2- and 10-year inversion to just 24 bips. However, subsequent data, including easing inflation, brought rates back close to where they started, with the 10-year Treasury ending the quarter 16 basis points higher. And it's hard to talk about the economy without mentioning the Fed. On the next slide, you can see the shifting mindset. The June meeting at the Federal Open Market Committee yielded no surprises for the market when the Fed funds rate was kept on hold at 5.25% to 5.5%. Also widely expected, the median expectation for rate cuts was ratcheted down. In March, the Fed's median year-end projection for the Fed funds rate was 4.6%, so 3 to 4 cuts in 2024. And then in June, the median forecast was 5.1%, so just 1 cut from current levels. It's worth noting that the dispersion of forecasts is narrow in 2024 and for the long run, but expectations vary considerably for 2025 and 2026. Longer-term inflation expectations remain intact, reaching 2% by the end of 2026. The latest core PCE price index reading, the Fed's favorite metric, was 2.6%, so the lowest annual rate in 3 years. So if inflation continues to moderate, we can likely anticipate that the first rate cut will come later this year, hopefully in September, but any upward inflation surprise could push rates further down the road. Taking a look at U.S. equity performance, the S&P 500 index finished higher in Q2. For the quarter, growth outperformed value in the large, mid, and small cap spaces, although the gap of outperformance was most notable in the large cap space. Looking at the chart on the top right, you can see the Russell 1000 growth was up over 8%, while the Russell 1000 value was down 2%. All small and mid cap indices were largely negative for the quarter. And then at the bottom of the page, you'll see sector performance. Technology, communication services, and utilities were the best performing sectors, while materials, industrials, and energy were the worst. This has been one of the most concentrated markets of all time. The top 3 companies, Microsoft, NVIDIA, and Apple, and the S&P 500 currently make up roughly 20% of the index. Not since 1980 have the top 3 been this concentrated. Moreover, the top 5 companies, NVIDIA, Google, Microsoft, Amazon, and Apple, have been the source of almost 60% of the S&P 500 return year to date, 57% to be precise. In 2023, they're about half the return, and then narrowing the field even further, NVIDIA alone has been responsible for 30% of the S&P 500 return so far this year. With this type of top-heavy returns, it's no surprise that small cap stocks continue to lag large caps. In the first half of 2024, the 12.5% performance difference between small cap, the Russell 2000, versus large cap, the Russell 1000, was the widest since 1973. Taking a look at international stocks, they rose modestly in the second quarter. We saw market leadership reverse as China snapped back and Japan fell. Outside the U.S., emerging market stocks led the way for the quarter, especially emerging market Asia. China made progress in its battle against deflation, with consumer prices rising throughout the period and GDP exceeding expectations. Taiwan saw strength in the semiconductor industry, and India was also up sharply for the quarter in spite of a short-lived sell-off after the election. Conversely, Japan, Canada, and the IFA region recorded a negative return. The Japanese central bank faces ongoing challenges maintaining the yen's value, which has continued to slide relative to the dollar as U.S. interest rates remain high. European stocks were essentially flat. France was a notable underperformer, given concerns around the potential outcome of President Emmanuel Macron's snap election. And overall, the U.S. dollar advanced against most major currencies, with the MSCI ACWI index ex-US up about 1%. Taking a look at fixed income assets posted generally flat returns amid a modest uptick in interest rates. Bond yields have trended higher as the timeline for a federal funds rate reduction is extended. Riskier fixed income categories such as leveraged loans, high yields gained, whereas U.S. Treasuries, mortgage-backed securities, and municipal bonds each returned flattish results. Treasury rates rose modestly during Q2, with most fixed income categories ending with yields near their long-term historical averages. Meanwhile, credit spreads ticked up in most sectors, generally ending the quarter around the lower end of their historical range. The Bloomberg Aggregate Bond Index, a proxy for intermediate maturity bonds, was up in the recent quarter but flat for the year to date. Mortgages were the only sector to underperform U.S. Treasuries on a duration-adjusted basis. And overall, fixed income yields suggest valuations that are roughly in line with long-term averages and better than the past decade of low yields. Lastly, taking a quick look at private real estate performance. While the pace of benchmark negative value change slowed this quarter, valuation challenges remain as the industry continues to wrestle with the impact of higher interest rates and debt costs, lower transaction volume, limited debt availability, and structural changes in the office sectors. All property sectors and regions experienced negative appreciation with the exception of hotels for the quarter. And MSAR's real estate funds actually managed to eke out a positive return with income that outpaced depreciation for the quarter. Unless there are any capital market questions, I can pass it on to Claire, who will cover performance.
Yes.
Great, thank you.
I thought the danger in China was more of deflation rather than worrying about inflation. I was just sort of wondering what the real outlook was in China.
John? Outlook in China.
Yeah, I mean, there's no doubt that the Chinese economy is challenged right now. To your point, that their monetary policy is actually going the opposite direction, right? In terms of they're trying to stimulate the economy right now. And to your point, and it's been manifested obviously in the equity market as well. China has been a huge laggard, right, in terms of international performance. So yeah, I mean, yeah, China certainly has a lot of issues. I guess just kind of moving back to 30,000 feet though. Again, at the end of the day, we're talking about the second biggest economy in the world. So in terms of what makes sense to incorporate into your overall asset allocation, you still want to have that exposure to China going forward.
I have a follow-up question. So you're talking about capital markets assumptions. I think a couple months ago we saw from Alan, maybe it was 4 projections for bond returns for our portfolio were something around 4%, exact number. I do want to note that in the last 10 years, trailing 10 years, we earned just under 2%, and the Bloomberg aggregate was about 65 basis points less than what we actually earned, so we outperformed the Bloomberg aggregate by about 65 basis points. Hooray for us. But still 2%. So the question I have is, because I've been reading some articles on Morningstar where they're showing 10-year yield for treasuries are going down. Mm-hmm. Do you still expect that our bond portfolio will earn in the neighborhood of 4% over the next 10 years?
Yeah, no, that yeah, if there's one thing that's materially changed kind of in the last 3 years, it is the expectations for bonds. To your point that I mean, basically interest rates at the short were basically zero, right? So the bond yield is obviously governed by the overall level interest rates. So interest rates were exceptionally low, right? And as you said, I believe you said that, a 2-3% realized return for bonds over the past decade.
2%, which is less than inflation.
Yeah, exactly. So a negative real return right after inflation return. Now, the forward-looking sense that in terms of our expectations for the investment grade bond market, so that's the Bloomberg aggregate, as of this year, right now, our assumptions on the order of 5%. So we're talking about was 2%. Interest rates went up a ton. Now it's kind of in the range of 5%. And to your point, Dan, I think what you're suggesting is, okay, now it looks like the Fed's starting to do an about face, and that inflation seems like it's been squeezed out of the system, driven to some extent by the high level of interest rates. So In a forward-looking sense, what I'd say is we recast our forecasts on an annual basis. There will be an incremental decrease, is my gut, in terms of what our expectations are in a forward-looking sense for the bond market. Because again, what will be happening over the next, let's call it 6 to 18 months, there will be, on the short end of the curve, the expectation will be lowering interest rates. But again, not all the way down to zero like they did as a response to the global financial crisis. Now the cash is like 5.25 right now. The market expectation, I want to say, in the next 12 months is perhaps for that to move down to, say, 350, something like that. So I'm giving you a long-winded answer, but I guess we anticipate an incremental decrease in our forecast for the bond market, but it may go from, say, 5 to 4.75, 4.5, rather than what you all were facing right back 3 years ago. So it doesn't, I would say it doesn't undermine that fundamental role as the bonds as the anchor in your asset allocation, the defense, if you will. Does that make sense, Stan?
I'm trying to get the time horizon, though.
Okay.
We all know it's going to go down, but how soon? So I'm kind of looking at portfolios in terms of 10-year performance periods,
Sure.
not 2 or 3, spikes up and down here
Yeah.
or there. So
Yeah.
when you're talking about a forward projection for bonds, are
Yeah.
you thinking in the neighborhood of 4%, or are you thinking in the neighborhood of 3%?
Okay, that's okay. So, and so we formally set our capital market expectations actually in the fall quarter for our 10-year assumptions. And so we're just starting on that process. So I'm kind of, if you put a gun to my head and said, what do you think our projection is for the next 10 years for the broad investment grade universe? I would say the 10-year forecast will probably be between 4.5% and 5%. Because again, think about, we're talking about investment grade bonds, so it's not just the treasuries, right? You're going to be getting, there's corporate bonds, mortgages in there that yield more than the base treasury. So you have to think about the treasury and then kind of adding on some extra return for those elements. And actually, if you look, for example, like if you look at the yield to maturity of that Lehman or the Bloomberg Aggregate Index, you can type it in on the internet. That right now it's about 4.5%. So again, that's kind of a super rough estimate in a forward-looking sense for the yield or for the bond market. Sorry.
Well, I'll just note that in the last 12 months,
Yeah.
The Bloomberg Aggregate earned 2.6, and we earned 4.4. So that was even better than our 10-year average. But we just we're currently in and just have exited the high point in all probability of bond rates. Unless there's another inflation scare or something else where the economy's overheating, we're not going to see bond rates go up. I guess you could say a third option would be unless people just don't want to buy U.S. Treasuries and they sell for higher than they've sold in the past. But anyway, I guess I'm kind of curious, if we just had the highest bond rates issued in the last year and they're going to go down, why did we only earn 4.5%? Bloomberg Aggregate only 2.6, and you're saying in the next 10 years you think we're more likely 4.5, 5. I mean, it seems to me it would be less than we just earned in the last 12 months.
I mean, I'm not answering your question directly. I think when we think about the fixed income, though, as kind of a component within your overall asset allocation, it's the role kind of in combination with your asset categories to invest in, recognizing that the projection for absolute returns will certainly change over time depending on a lot of factors, but one being changes.
So one final question. When you guys do bring in your forward projections for the next 10 years, could you bring in what were your forward projections 10 years ago?
Yeah, that's something that we look at on a regular basis, is kind of what's been the history of our forward capital market projections, and where have we been right and where have we been wrong?
Yeah, and I think and we actually have a slide. We obviously kind of continuously audit how did our forecasts do, going back 10 years, the exact exercise you're suggesting. I guess what I would say there is that it's important to focus on that aggregate number, right, across all your asset classes. What did Callan forecast and what was realized? And so maybe, I know it's been the case, obviously, for individual asset classes, we may not have gotten things exactly right depending on the window you look at. But when you look collectively in terms of how those things fold up in the portfolio, Callan said that you're going to get X%. How did it fall out relative to that? It's actually does a surprisingly good job of predicting. I shouldn't say predicting, that's too strong a word, but creating reasonable expectations for forward planning.
So I would like to just kind of second what John's saying there, as I have gone back and looked at the broad portfolio projections for Callan from over a decade ago, and they're pretty close. I mean, nobody knows the future, but they're not that far off. You know, the other thing that you want to consider too, when you're thinking about the fixed income, is there's the two pieces. There's the income and the appreciation, the yield, which is what you're asking. You know, it depends on what type of manager is buying. Out of our two managers, depends on what duration, what's the length of time that they're buying these bonds for, right? If they could have bought some new issue bonds, let's say last October, that were a 5-year, maybe non-callable for 2 or 3 years if it was a corporate, you know, that yield's only going to last until the callable period ends, 3 years. So there's a lot more nuance when you're trying to consider yield in a forward-looking sense than just the one number that Callan projects as a return for our portfolio, which I think is 4.25.
Is there a type of asset class? Well, I guess you could report in a future meeting. But my understanding from what I've read is that forward projections, and I'm not looking specifically to Callan, but just generally, forward projections have been farther off the mark on international stock returns than they were for U.S. domestic. And the U.S. domestic has basically outperformed forward projections if you went back 10, 15 years. And that international has underperformed based on forward projections that had been made at the time. So I'll be curious to see what Callan reports on the look back, but that's been my reading, is that international has been overestimated their future returns, and it's underperformed for 10, 15 years now.
Yeah, no, you're spot on. Large cap U.S. markets have dominated small cap, frankly, as well. Small cap and international have underperformed large cap U.S. equity to a degree that was not anticipated.
We'll put an IOU that we actually have a slide in my piece of the deck just emphasizing that historically the performance of U.S. equity versus international equity, it's been cyclical, and there's been very long periods like now where the U.S. has been in the ascendancy, but you know that you go back to, I mean, I think, you know, go back to the 80s, Japan at one point, that their stock market, as you all know, basically eclipsed the U.S., right? So these things, I guess my point is that we still think your best defense is to hold both, to be balanced, you know, because again, to your point, nobody has a crystal ball. That certainly the U.S. has had an incredible run, obviously recently, but it makes sense to hold them both because again, the performance has been cyclical over time, and won't dispute your point that U.S. has done better than we or many other forecasters expect. Conversely, international has done worse, but again, in a forward-looking sense, we think you need to hold them both.
And Dan, to your earlier conversation, as you all know, we did the asset liability study, talked about asset allocation at a big picture level over the last few quarters. We're now marching through the asset category focus studies. We talked about domestic equity first. Today we're talking about international equity in more focus. And then next up, obviously, we're gonna look at fixed income as well. So get there. Jumping in, unless there's any other questions, I'll jump into performance as of June. So of course, June 30 is your fiscal year end. So we're looking at the end of another fiscal year, and it was a positive year. So we saw a pretty strong return in absolute terms, the total portfolio up about 9% over that time period. And as we see here on page 11, as of the end of the fiscal year, the plan hit a new high water mark in terms of total assets. So finishing the quarter at about $715 million. We also today have the July update. Markets continued to climb and the plan finished the end of July at $730 million. So good news from a total picture perspective. At the bottom half of the page here, we capture total asset growth in the plan over the course of the fiscal year. So just a year ago, at the end of June 2023, the plan was about $663 million. In aggregate, you saw about $62.5 million in investment gains over the last year, and about $11 million that left the plan to pay benefits and other expenses. So again, finishing at $715.4 million as of the end of June. The other thing you can note here on this page is smack in the middle of that bottom chart, the net new investment column gives you a good picture of how money moved among the asset categories over the course of the year. So you did see some rebalancing out of winners, so that's domestic equity, and into fixed income and international over the course of the last year. Moving one slide ahead, we look at asset allocation as of the end of the quarter for the plan on the left versus the strategic target on the right-hand side. Those two pie charts look very similar. Robert continues to do a great job of keeping the total asset allocation of the plan really right in line with that policy target as codified in the investment policy statement. The bottom half of the page here looks at that same information but in dollar terms, dollars allocated to each asset category, and the percent difference column is what I look at. So what the percentage difference was of the actual asset allocation of the plan versus target as of the end of the quarter. And most importantly, all of those differences are within the approved range, again, as codified in your investment policy statement. So things moving right along there, no surprises. I'll skip ahead 2 pages to page 15, where we look at the detailed asset allocation as of the end of the quarter. So how the dollars in the plan are allocated among all of the individual asset categories and asset managers, and how that's changed over just the last quarter. So since the last time we met as of March 31st. Starting at the bottom of the page, you can see that the total plan started the quarter at about $711.5 million. You saw investment gains over the quarter of $6.7 million in aggregate, $2.9 million that flowed out of the plan, and again, finishing the quarter at about $715 million in total. I also like to look down the page, asset manager by asset manager, and look at the balance between growth and value within your mid-cap managers, your small-cap managers, the allocation among all of your international equity managers, and then the balance between fixed income, Dodge & Cox, and PIMCO on down through real estate. Big takeaway here is that things do remain in balance, again, keeping growth and income in balance within mid and small cap. The intended asset allocation among your international equity managers, again, continues to be as specified, and then balance between your fixed income managers and your real estate managers as well. Once again, good news there, no surprises. Moving on to performance, here on page 16, we capture performance for the total plan as of the end of June, and longer annualized time periods, again, ended June 30th, 2024. For the last quarter, the plan was up just shy of 1%, up about 92 basis points. That did trail the total fund benchmark, which was up 1.4%. Over the last year, again, a full fiscal year, up 9.4% for the total plan, again, behind the target, which was up about 10%. The main headwinds to relative performance in the quarter were, one, within domestic equity, the overweight to small cap. So Hannah, when she went through capital markets, mentioned that large cap U.S. equity continued to be the most dominant place to be. Small cap trailed, so we saw a negative return out of small cap in the quarter, and over the last year, small cap also trailed large cap. So that structure, being overweight to small cap within domestic equity, was a headwind over that time period. The biggest headwind to your relative performance was actually your international equity composite, so the active management within non-US equity, and that's what we're going to spend most of the time talking about today. So that's really where John's discussion is going to focus. You know, are there changes that you want to make to the implementation of your international equity structure? Importantly, longer term returns, all positive. In absolute terms, it's always good to see positive numbers across the board here. Over the last 10 years, the plan is up 6.8% on an annualized basis. Over the last 15 years, up almost 9%. As always, the other information on this page is performance versus a peer group of other public defined benefit plans. So that's what's represented by the gray distribution. If you look over those longer time periods, particularly 5 years and longer, your plan has done very well versus that peer group of other public defined benefit plans. So your asset allocation, your implementation of the asset allocation has fared quite well when we look at performance versus peers. Pages 17 and 18 capture fiscal year returns. The most recent, of course, being on the far left. That's the full fiscal year ended June 30. Again, up 9.4% versus a 10% return for the target. Between this page and the next page, what strikes me most is that when we look at performance versus peers, again, looking at performance versus that gray distribution, it used to be, so when we look at this 5 years versus the previous 5 years, you tended to be kind of top or bottom of that peer group. And over the last 5 years, you've really landed closer to the middle of that distribution. And I think that speaks to some of the work that the board's done to try to, bring performance kind of closer in line with that median, cutting off some of the volatility and the tails that were driven by the higher public equity allocation over past periods. For example, implementing infrastructure within the portfolio, I think that's really been successful to the intent that the board intended, or which the board implemented. All right, shifting ahead to page 21, we look at attribution. So what drove outperformance and underperformance versus the strategic target. Here we're looking at the last quarter and the last 5-year time period. What stands out in the recent quarter is that the international equity allocation, as I mentioned previously, has been a headwind to relative performance. I mentioned over the last fiscal year, the same has been true. So the biggest headwind to your relative performance of the actual portfolio versus the target, has been that active management within the international equity portfolio. Looking at the top half, again, just focusing on the last year, I mentioned the total plan was up 92 basis points. The target was up 1.36%. And active management, that manager effect, is what led to the underperformance, subtracting about 46 basis points, the headwind of about 46 basis points. Over the longer 5-year period, the manager effect was actually positive. So the plan performed in line with the strategic target, outperformed by a couple basis points, but ultimately active management, the implementation of your asset categories, was a tailwind. Asset allocation, so slight differences from policy target, in particular an overweight to real estate in the last year, that was really your headwind to relative performance. And then I'll round out the performance review on the next 2 slides, where we have performance for every individual asset category as well as your investment managers. Performance for the domestic equity composite is captured on page 22. The total domestic equity composite was up 2% in the recent quarter. That trailed the Russell 3000 index, which was up 3.2%. Over the last year, a pretty notable absolute return, so up almost 21% in the last year. But again, that trailed the Russell 3000 index, up 23%. Much of that really being driven by the structural overweight to small and mid cap, which trailed large cap US equity in the quarter. As you know, large cap, which is the majority of the implementation of your domestic equity portfolio, is implemented with a passive S&P 500 index fund. You take active risk within small and mid cap, 2 mid cap managers, 2 small cap managers. And when we look at your mid cap composite, so your mid cap managers together, and then your small cap composite, small cap managers together, they've actually done quite well. The growth and value managers within each of those categories continue to be good complements to each other, continue to fare well over longer time periods versus their peers. It's just that that overweight to small cap as an asset category has been the headwind to the relative performance within domestic equity. Performance for the remaining asset categories and investment managers is captured here on page 23. International equity is captured at the top kind of third of the page, really. And again, that's been a key headwind to relative performance. So over the last quarter, you saw a slight negative return for the composite. The last year, a positive 8% gain. Good news, but that certainly trailed the ACWI ex-US index, which was up about 12%. Again, that's where we're going to spend most of our discussion today.
Maybe a teaser. I know that's a pretty small chart. I guess y'all can read on your screen better, but it's certainly Mondrian and Oakmark on the international equity front. They've underperformed kind of serially, you know. And so this is just kind of a teaser as we get ahead to the structures, right? We're going to show some alternatives that potentially take them off the table to try to create a more stable performance for y'all.
Continuing down the page, we look at fixed income. Your fixed income portfolio, benchmarked to the Bloomberg aggregate, has fared very well versus that benchmark over time period, over both near-term and longer-term time periods. Fixed income is implemented with Dodge & Cox and PIMCO. We think those two managers continue to be good complements to each other from a strategy perspective. And when you put them together, their performance has certainly outperformed over time. And then the remaining managers, your infrastructure managers, your real estate managers. I think the big highlight on your private market assets, as Hannah alluded to, is that we are starting to see a shift in real estate. While very marginal, you did see a gain out of your real estate composite in the recent quarter, so up just 5 basis points, but that's certainly a change from what we were looking at for the previous year, really, where we saw significant depreciation and write-downs of assets for both of your managers. At this stage within the real estate market, we are starting to see income account for, or make up for, I should say, the ongoing depreciation. So hopefully valuations hitting a low, and again, with income starting to become a positive component within those portfolios. Returns for the total fund, we already covered, but again, listed at the bottom of the page here, total fund versus benchmark across both near-term and longer-term time periods. I'll pause there for questions before we dive deeper into the international equity structure and review.
So while you're on this slide deck, could you go back to page 20?
Sure.
So this is our total portfolio over 15 years, and to me the important piece here is our portfolio, which has evolved during those 15 years. It had even more active than it has today, but in large cap US, basically. It had higher standard deviation or higher volatility than what it would have, if I read this correctly. The benchmark for MSER's target is as if we had had the money invested in index funds, but we don't, by and large. We have the bulk of our stocks in actively managed mutual funds. And it's showing a standard deviation of about, over a 15-year period, of about 1.5% higher, which would be about a 3% shift, both on the high and the low, than what we would have had. So it's more volatile. And one of the reasons why people have bonds in their portfolio is to reduce the volatility of the stocks. So I've always contended, let's not just focus on any particular stock fund, and its total performance, let's look at its total performance in relation to its volatility. And I've got to say, I've rarely heard Callan talk about our mutual funds in context with their performance in relationship to their volatility. We often hear, well, this one's beating the benchmark, therefore it's a good fund. But if the price of that beating the benchmark by, let's say, a half a point, 50 basis points over 10 years, is you've got an extra 400 basis points in volatility, that may not be worth the trade-off, because it may mean you want more bonds in your fund, which were not even equaling inflation in the past 10 years. So, the reason why I wanted to focus on this was I wanted to just highlight over the last 15 years, because we're on this slide deck, our portfolio was about 3 percentage, 1.5 percentage points on the high end standard deviation, but again, that's high and low. So it's really about 3% more volatile than had we had indexes over that 15 years. And I don't know if you're going to go to it, but in the full report, page 46, which goes to the international, and it leads into your next discussion, because I don't know if this is going to be part of your presentation, but collectively on page 46, it shows the volatility and the performance of our international versus an index of the international. Not only did we underperform in terms of returns by roughly 1 percentage point, but we had over 3% higher standard deviation, which would be close to 7%, greater volatility on the high and the low of what we would have had we had indexes. So not only would we have earned an extra 1%, but we would have had substantially less volatility. And since it's roughly 25% of our portfolio today, I can't say what it was 10 years ago, to add that much extra volatility to your portfolio, when it's 25% of your portfolio, it accounts for over half of our total funds extra portfolio above the index is just being driven by our international actively managed funds. So not only are we underperforming the target by a little bit in the entire portfolio, I agree. Now, one difference here is your page 46 report only looks at standard deviation and performance in that particular graph on a 5-year backward basis. This is a 15, so I don't have the 15-year look back in terms of standard deviation, but I have a feeling that the standard deviation of our international, if you were to produce for 15 years, would look something like your 5-year look back, not dramatically different. So again, I'm curious about what you're going to say about the international, but our actively managed funds did not just underperform, they added a substantial amount of volatility to our total portfolio. And I think that is a discussion that I think this board and Callan should have more upfront in our discussions about active versus passive.
Yeah, I think in what you'll see in the structures that we've created is that right now, to your point, that in terms of how different your international equity exposure is vis-a-vis your benchmark. So your benchmark is the equity ex-US. That's a combination of, think of it as 70% developed international markets and 30% emerging. So your portfolio right now is quite different. And we'll show you some explicit metrics where we're showing you how different your portfolio is vis-a-vis the benchmark. I guess the good news is that much of that difference is driven by one specific manager. One manager is extremely concentrated and incurs a great deal of risk in the portfolio. And you'll see in terms of our recommendations, we're actually suggesting to take that manager out of the portfolio, and you'll see some metrics that show that through reasonable changes, as well as perhaps adding some index to make the structure look more like the benchmark, that variability you described gets mitigated a ton. So I take your fundamental point that what you have now looks pretty different than the benchmark, but I think there's some easy steps y'all can do to remedy that, and that's what we're going to discuss downstream.
Yeah, Dan, I think that's a great segue into the rest of the conversation today. But to your point on risk, we're always looking at the risk of each individual manager, as well as at the total asset category and total fund level as well. So, where do you want to spend your active risk budget? You know, how do your managers, the risk and return profile of them, how do they fit together? And then looking at, you know, performance in the context of that. Is this what we expect from this manager and this deposit when we roll it up together? That's constantly what we're looking at and what we're weighing. To your point on this chart, yes, there is a higher standard deviation for your total fund versus your total fund target. And you as a board have actually worked to bring that within the circle here on this chart in particular in the last 5 years. So that circle, the ellipse here, represents the peer group, other public defined benefit plans. And if you'll remember just a few years ago, that total fund dot was actually outside of that ellipse. So it has over, you know, this is a 15-year look back to your point. So it takes a while to make those changes, but it's actually come down with some of the changes that you've implemented to the portfolio. Now, as John was mentioning, some of the active risk that's been implemented or some of the active management, I should say, that's been implemented in the international equity portfolio in particular, it hasn't paid off, right? So your international equity portfolio has underperformed the benchmark, and that's, you know, something we're going to look at in detail today. If you think about the structure of the international equity portfolio over time, and I think this is a good kind of segue into this discussion, you know, 15 years ago, you had a more proliferate list of active managers that implemented the international equity portfolio. And over time, you've worked to streamline that, to kind of narrow the list of names. And there have been a couple replacements over time, mostly taking names out, but there was a replacement when the Mondrian Fund was put into the portfolio. And that was really added within the context of the other managers that were there, Oakmark, Harbor, and Euro-Pacific Growth. So that filled a gap and complemented the other managers that were there. You also added dedicated emerging markets, dedicated non-US small cap. And I think today what we want to do is take a look at that total structure that you've held onto, that, to your point, has underperformed, and maybe take a fresh look at, you know, are there other structures that you want to consider, as well as potential manager. So we've got a few alternatives that we want to look at, your structure compared to different ways that you could implement the portfolio. And that's really where we want to focus the rest of the discussion today.
All right, guys. You get so we have a pretty big deck, but I think there's probably 6 to 8 key slides that we need to hit to convey what we're trying to show in terms of these potential alternatives to the current structure. We'll dip into some other material as appropriate. But I guess just let me start just a couple philosophical points that. As I mentioned, okay, you know, we've got roughly 25% of the plan in international equity. Okay, we talked the benchmark of the plan. Let's stay on this slide, and I'm going to jump. Okay, so there's a few decisions here. Okay, so in terms of your benchmark, and we talked about this a little bit related to the China question. Okay, the overall benchmark is 70% developed international, 30% emerging. Okay, that and there's also dimensions such as value and growth. Okay, so our prior here is let's create, and this is also kind of linked to the idea of having the structure behave more like the underlying benchmark. That we want to structure the portfolio such that those developed international, we want to hold those at the weights of the underlying benchmark, as well as value and growth. We want to keep those balanced. So we want, at the end of the day, what the idea is, let's create the structure such that we're taking those bets off the table, and then the success or the underperformance of the structure is really governed by the success of the manager's individual bets on the individual stocks in the portfolio. Okay, and so there's a structural component that we'll discuss, and then philosophically, this is important, guys, is the thinking about whether to be active or passive. Okay, in international space, and what I'll argue is it's not an either or. That right now the plan looks quite different than the benchmark, and we'll show you kind of detail in a second. But the idea of potentially adding a little bit of index or some index to the portfolio to kind of smooth the experience. Also, indexes have very low fees, right? So it would lower the aggregate fee that you'd be paying on the structure. I think that makes sense. But where I'd kind of qualify that is that philosophically, or if you look at empirics for the success of active versus passive, that, for example, if you look in large cap U.S. space, the empirics for active managers, it's not very good, bluntly, if you will. That and you know that many plans like you, when they actually implement large cap U.S., they'll have something like an S&P 500 index fund, akin to what you all have right here. The idea being, well, if we're going to do active management, we're going to pay these fees. Let's go out. Let's don't go in such a hunted fishing ground. I mean, these are the most analyzed stocks in the world, right? The S&P 500 stocks. Does it make more sense to be active in small cap? Does it make more sense to be active in international? And so let's flick to page 5 real fast. Okay. So this is kind of the tail of the tape in the international equity world. Okay. So what we're looking at here, these are looking at Callan's database across these 4 categories of international. Okay. And just to orient you, when I say global, that means a combination of the developed and the emerging. So that's called the ACWI. Again, that's your overall plan benchmark. We're trying to snap all these managers together to look like that in terms of style at the end of the day. And then there's developed in isolation. There's emerging. And then we're looking at small cap here. And so if you look at the empirics historically, and this is based off kind of an average, you kind of threw a dart and you end up with the average manager in each of these categories. You can see that, and this is on a gross of fee basis, that's important to make the distinction here, that in all these categories, active management in international has been fertile. Okay, and again, that recognition of these empirics, if you will, is why if you look at your peers, you look at pension plans, public pension plans across the board, they tend to have the bulk of their international assets invested actively. Okay, in contrast to what I said upstream, that the bulk of assets, for example, in very efficient market, large cap U.S. equity, that tends to be passive. Okay, so, and again, so philosophically, we believe that if you're going to try to beat the benchmark, that international equity is a good place to do that. But let me caveat here. Remember the numbers you see here, these are gross of fees. Okay, so in practice, obviously, your experience, what you care about at the end of the day is how much do I get on net of fees basis. But again, even if these adjustments were made, that again, we'd argue that international, you're still going to be positive on net of fee basis. Okay.
So I have a question about the chart.
Yeah, please.
So if I'm reading it correctly, it says this is rolling 3-year averages over a 20-year period.
That's right.
So why did you select a 3-year time span rather than just the 20-year returns? Because everything I've read about active versus passive is that a majority of managers can beat the index over short periods of time, 1, 3, even 5 years.
Yeah.
But it drops off to less than half, and it gets down to, depending on the segment, can get down to like 10, 20% that beat the indexes when you're talking about 20, 30-year periods. So we don't tend to swap out mutual funds every 3 years. We tend to hang on to, as evidenced by the fact that we've hung on to some pretty bad losers in the international equity for quite a long time. So why did you use 3-year rolling averages versus a longer period, like a 20-year period?
Yeah, if you could flick to page 27. Okay, and so yeah, we're not trying to cherry pick this in any way. Here's the underlying data behind what we're looking at here. So based off the Callan database, that if you look at this, you see the dark blue line there. That represents the historical return over time. Okay, and so you can see that kind of across the board that if you look any period over the past 20 years, right, and that the international equities outperformed its benchmark. Now, I kind of wish I'd included some of the U.S. slides, right? So again, it's a very different story in large cap. You know?
I'm reading this as 3-year, these are rolling 3 years again. So at any 3-year period, a majority of the active managers individually could beat the index. But for that one manager to meet it over a 15 or 20-year period, the odds go way down, and everything I've seen, that both a particular style or a process that a particular mutual fund applies can change, the managers of that fund can change, and their individual just approach to picking and selling, buying and selling, because the active manager has to know not only when to buy a fund, but when to sell it. So there's so many possibilities for making mistakes, plus adding costs to the fund. There's a cash drag when you have active funds, because they've got to have cash to buy something else.
Right. That's all embedded in the numbers, though. I mean, this is the actual empirical experience of the manager.
But I'm saying
so
this
if they have
to me
cash drag, it's in there.
But this to me means nothing, because they're only 3-year rolling returns. And
So if you're consistently outperforming on a rolling 3-year period, there's a pretty good chance that you're going to outperform time period. It also strikes me that the 3-year time period lines up with how asset liability study it. This plan, we actually are looking at domestic equity composite on a similar.
But this agency never picks a new fund and gets rid of it in 3 years. We hang on to funds for 10, 15, 20 years before we have enough scrutiny. So I think this is the wrong information you're showing the board.
Mr. Everlace?
Okay, let me jump in here. So when we're trying to look and make broad statistical statements like planning in this case, you need lots of numbers. You can't just use one 20-year period and make a decision based on that. You need to have, it's quite standard to have rolling 3-year periods or maybe a 5-year period. The more data you have, the better. If you just look at one rolling 20-year period, you're not going to capture a lot of things that can happen within that period, right? Because it's one 20-year period.
So rolling 20s would be far more impactful than rolling 3 years.
That could be the case, but you're not going to have data. You're not going to have enough data to make a statistically significant estimate.
I think the data does exist, except the fact that
You're going to have a lot of cherry picking biases, because you're going to have you're also going to have survivorship bias. There's going to be a lot of other problems that you're going to run into when you try to do a 20-year rolling estimate. That's part of the reason why these are much shorter time. Part of the reason.
And there's a reason why active funds don't have long survivorship, because they generally don't outperform.
I'm not debating that. I'm just telling you that if you want to make a statistical analysis, you need to have lots of data points.
I'm saying this is not a relevant data point.
You're wrong.
I think the intent here is really to take a look at, where is it worth spending your active risk portfolio? Where do you want to implement with active management? And so this is one way to look at, how active managers within the asset category have fared over a longer time. So this is one data point. I think.
Trustee. A 3-year layer for what?
For their forming the layer for the unfunded accrued, to determine the liability.
We use a 5-year period for asset smoothing as far as investment returns, and we typically use it does vary depending on the type of gain or loss, but an 18-year period for the amortization of the unfunded liability.
Right, I was more interested in the period for the layer.
Each layer being 18 years, depending on the type of gain or loss. Let's say we had a retirement incentive. Those are amortized only over 5 years, but in that same year, we could have an actuarial gain or loss due to mortality that is spread out over 18 years. So it's the most common is 18 years for the amortization of the gains and losses.
Okay, well, thank you.
Maybe we can get back to the start of the presentation.
Okay, let's go ahead and jump to page 8, actually. Yes, ma'am. Okay, so it's some philosophical considerations, right? We let off, and again, I guess I would underscore this active and passive is, yeah, it's been debated forever, right, in terms of how we've seen institutional investors allocate their active risk budget. It tends to be more U.S. small cap, international, that people can argue over the nuances of the data, but in terms of how actually people put their money to work, that's how it's been done. But what I would say, and again, I tried to lead off with this, this isn't like a religious battle between active and passive. The point is that you can blend these things together. You know, that again, your current structure has a lot of variability relative to the benchmark. And a lot of those things are actually driven by one single manager. You'll see that in a second. So we think that there may be kind of a way to meet things in the middle where you still are trying to beat the benchmark with some allocation to active management, but then perhaps have some index in there to kind of smooth the experience and lower fees. Okay. So here's our current cast of characters here on page 8 in terms of the current structure. So again, right now the structure is 100% active, 0% passive, right? Composed of the 6 managers you see on the chart here. And remember, I said that one of the things we're trying to do when we build the structure is we want it to look like the broad international equity market. So again, that's 70% developed, 30% emerging. Okay, and so you can see kind of different styles of managers here, right? So you have a Harbor and Oakmark, which are developed international equity. Okay, you can see emerging markets in orange. That's 91, right? So those 2 things you could think as specialists in either developed markets or emerging markets. And then where you see in kind of the blue, those are the Euro-Pacific Mondrian. Okay, they look across both developed and international markets to try to beat the benchmark. Okay, and then there's a small cap allocation as well to T row. Okay, so I just talked about kind of the regional exposures of these managers, that they also have different styles, okay, in terms of being either a growth manager, a value manager, or a core manager. And again, as I mentioned when I was kind of doing the philosophical considerations upstream, we want to blend these managers together such that that style is netted out. Because you don't want a situation, say you had two value managers in your portfolio, they could both beat their own benchmarks. The only job they have is to beat their, they could both do well, beat the value benchmark, but then if you have a situation where growth as a style outperforms value, kind of those good work that those individual managers did kind of gets drowned out from having an incidental style bet. So we need to be careful to kind of mitigate those bets there. Okay, and you can see that right now the portfolio has 2 growth managers, 2 value managers, and 2 core managers, so it's pretty balanced in terms of that style exposure. You can see the weightings of the portfolio. The weightings of the portfolio are constructed again to get you pretty close to that 70 developed, 30 emerging exposure. Let me just make a couple comments about some of the individual managers, and that'll help, I think, motivate the potential alternatives. Okay, Harbor's performance historically it's been unspectacular. If you look over time, it's modestly underperformed the benchmark. Oakmark is the one that really, I think, makes sense to replace, in the sense that Oakmark, okay, it's only 20% of your portfolio, and this goes back to Dan's comments on risk, that Oakmark is constructed to only hold about 50 or 60 securities. So you're trying to, so if you have 50 or 60 securities in the global market, we're talking, several thousand securities that it's far less diversified, right, than a broad index. And that's where a lot of that risk is conferred. And it turns out that even though Oakmark is only 20% of the portfolio, in terms of the amount of risk it confers to the portfolio in terms of variability versus your benchmark, it's actually over half. You know, so it's like, it's one where the plane, to some sense, in terms of its experience relative to the benchmark, is flying to heavily extent on the success or failure of Oakmark. And bluntly, right, Oakmark has not done well in recent years, right? So again, kind of, even like tabling the active passive, just the act of replacing Oakmark will reduce the variability of the portfolio experience quite a bit. That we're going to suggest coupling that with an allocation index and the recommendation to see in a second. Europe-Pacific growth manner has done well historically. Mondrian's been kind of a serial underperformer as well. Even they're a value manager, but even if you adjust for the fact they have a value benchmark, they just haven't delivered the goods. So that's one that we're recommending re-examining in the structures here. And then 91 has it's done decently. It's performed slightly above the benchmark. And then the T-Row, the small cap manager's done okay. So really, in terms of kind of low hanging fruit, like Oakmark is I think is the one that is quite a culprit in terms of the actual experience of the plan. Okay. And let me pause there. You'll see where this is going in a second, hopefully, but I want to kind of set the stage, if you will. Let's go to page 10. Okay, and so when we talk about tracking error, again, this is linked to Dan's point. This is how different the plan is relative to the benchmark. Okay, and the reality is you have to that's how you try to get outperformance over the benchmark. You have to make bets in terms of active bets that differ from the benchmark exposure. So active manager has to do that, but then what we want to look at is collectively the tracking of the portfolio is very, in my experience, is very high relative to the benchmark. That you can see it's about 3.5% tracking error. And again, it's to measure how different the plan is relative to the benchmark. And so here I just did a stone simple exercise where I took your current portfolio and then just said, remember 20% of the portfolio was an Oakmark. What if we took Oakmark out of the portfolio? Okay, and here I substituted with an index fund. How would that change the characteristics? And you can see that tracking error is cut by about half when you look at that. So again, Oakmark is kind of driving to a significant extent whether the structure does well or poorly. Okay, and so what does that tracking error mean in practice? This is kind of this is what the experience of the portfolio would be kind of with and without Oakmark being the orange. And the point being that, and it's not like Oakmark is always dragging the portfolio down. You can see that what happens is the behavior in terms of the portfolio return relative to the benchmark it's more like the benchmark, right? And this is kind of, so I think it makes sense in this, and again, the portfolio success or failure is really not predominantly determined by Oakmark if they were replaced. So let me pause there. That I know that Dan had Dan point out some of the risk characteristics of the portfolio, and I guess I would suggest that much of the current risk characteristics of the portfolio are driven by that single manager. Does that make sense in terms of?
It makes sense.
Okay.
But as we know, Callan does get paid by many of these companies. So I think there's a reason for you not wanting to just go to the index and just cut to the chase.
Yeah, again, I would say that it's really the empirics we discussed up front philosophically that makes us, and again, yeah.
So by my figures, under 25% of our portfolio underperforming by more than 1% over a 10-year period is a loss to the fund of over $16 million. So it's not just noise. I mean, that's 16 million, it's actually more than 16, it's probably like $18 million in underperformance. That's money that's not in our fund because we did not have an index for the last 10 years in internet. So are you saying this one change is gonna bring us back you're gonna guarantee 10 years from now that we're gonna equal the index or exceed the index? I mean, why not just go with the index? Then we know we didn't underperform.
I believe all index is on page 14 as alternative 3, is it not?
That's right.
Thank you.
That's right. Okay. Yeah, so what we want to show is the current structure. Yeah, what are some intermediate steps that kind of can mitigate the risk of this portfolio, in our estimation, create a better portfolio over time? And then obviously one pole is the passive option, which is always an option at the end of the day.
So one thing I want to point out, at least on this slide, we've sort of talked about it a little bit here and there, the notion of tracking error, and we're basically expecting active tracking error between 2 and 6%. And I've said that a few times over the past few meetings. So we can see here, internationals about 3.5. This single change alone, according to Callan, would bring down much closer to the lower end of the active range.
Yeah, and let's spend another, if we just flick one side to 11, just try to cement what we're talking about with the tracking error, because it's a very important concept here. That and to Dan's point, that you could put your entire international equity structure in an index, right? And then you're basically getting that orange line, right? No alpha, no outperformance, but no underperformance, right? So that's certainly an option. And so think of that as 0% tracking error, right? And again, we're modeling the portfolio at about a 3.5% level tracking error. And what you can see here is that basically the higher the tracking error, the greater the variability of outcomes around the benchmark, okay? And so when you get bad performance, the higher the tracking error, the worse performance is going to be, right? And then I could flip that and say when performance is good, right, the greater the outperformance you're going to get with a higher tracking error. But again, in practice, that we generally find plans having, a significant lower level of tracking error than what you all have right now, right? So again, it's not a right or wrong answer. It's just that you can use the amount of indexing in your portfolio to try to kind of, how much active risk am I comfortable taking, And so that index is a dial to let you control that, okay? Let me pause there, because and again, it's like your asset allocation, right? And you say, well, how many equities do I want versus bonds, right? There's no right answer in terms of where you want to be. It depends on your risk tolerance. It depends on plan-specific circumstances. And it's the same thing here, that kind of that risk mitigation function. And when you're staffing the managers, that's what the indexing does, right? That makes your experience look more like the bank.
Well, I think, again, one of the reasons why people, throughout the world, specifically in the United States, have flooded to indexes is because they don't like the tracking area. In our case, it's $18 million that's not in the fund because we didn't have international index for the last 10 years. So we're in the hole $18 million right now for the last 10 years performance.
I will say hindsight is 20/20. And I think if we let them get to the point of presenting the alternatives, I have a couple of questions as well. But I think that at this point, we're just grinding on nothing, and we need to get to the alternatives for discussion.
Okay.
Thank you.
Okay, let's carry on. Let's go ahead and hit those alternatives on page 14. So the actual alternatives are on 15, but just kind of philosophically where we're going here. Page 14, so see the current structure, right? Again, we said 100% active, composed of 6 active managers. High active risk, right? So we want to mitigate the active risk. That alternative 1, for example, what we're doing is we're moving from, we're reducing the number of active managers by 2, and we're replacing those 2 managers with an index fund. Okay, and again, one of those managers being Oakmark that we discussed that is contributing a lot of volatility to the overall structure. So just trying to streamline it in that manner. And then there's and then the other change. Well, the other change is to add another emerging market manager to the mix to try to diversify the experience. We'll talk a bit more about that in a second. But then the way, high level, replace volatile manager, incorporate index, some degree of index, right? That's alternative 1, which kind of represents kind of a middle ground between where you are now and kind of a fully indexed approach. Alternative 2 is more down that spectrum in terms of adding still more index to the portfolio. And here we're talking about for the entire developed international equity allocation, just let's index at 100%, and then to try to seek alpha, let's do that in what we think are the most inefficient markets, emerging markets in small cap. Okay, and you'll see that again that has a significantly lower active risk vis-a-vis current and alt 1. And then the pole, right, is alt 3, where we just index the whole thing. To Dan's point, no surprises, low fees, but again, kind of giving up the potential opportunity to outperform the benchmark. And again, so that kind of makes sense in terms of we're trying to lay out a continuum, right? And again, I guess we'd argue you're probably kind of the extreme end of the continuum now, being 100% active coupled with managers bringing a lot of risk to the portfolio. Okay, so where the rubber hits the road. Okay, this is kind of the key slide of the entire presentation, is page 15. So now we're putting kind of the actual numbers behind the philosophy I showed you on the previous slide. Okay, so you see the current structure here to orient you. And again, 6 active managers, a total of 6 managers right now. And so as we move from current to alternative 1, you see that in the alternative, both Harbor and Oakmark are being removed and replaced by developed market index. Okay. As we kind of move down the page into those all-country world ex-US managers, those managers can invest both in developed and emerging markets. Here, Euro-Pacific is being retained at its current weights. And then replacing Mondrian with a new value manager. Okay. And then in the emerging market space, it turns out to, again, remember I said we want the structure to be 70% developed and 30% emerging. So the way the math works when you make these changes, you actually have to increase the dedicated emerging allocation up to 15%. Okay, so what we're suggesting here is that as we get to kind of 15% of the portfolio, it may make sense to incorporate another emerging manager to complement 91. Okay, and so those are the changes in alternative 1. That so high level, the structure will go from 100% active, 0% passive to 60% active, 40% passive. Obviously, there's a fee reduction as well, as you can see there. And then also in terms of the tracking error of the portfolio, those changes reduce the tracking error of the portfolio by about half, if you will. Okay, that's alternative 1. And then alternative 2 is where now we're indexing that all-country world ex-US exposure as well, right? So the Euro-Pacific and Mondrian move out of the portfolio, and now basically over 60% of the portfolio is an index, while still retaining some allocation to active in emerging markets and large cap space. Okay, and so there you can see the tracking error goes down further to 1.2%. You can see the fee reduction, right? Because if you got more index, you're paying lower fees. Reduction in the number of active managers, reduction in the number of total managers. And then again, alternative 3 would be let's just index the whole thing. No surprises, de minimis tracking error, very low fees, and call it a day, if you will, right? So I think those are all kind of, potentially viable options. I guess in terms of what Callum thinks, you think that you think alternative one makes sense? Or again, reducing the tracking error and reducing the fees while still not kind of throwing, not punting completely on the asset class as a place to add value, right? But maybe it should pause here, I guess, for discussion, right? Kind of lay the different ideas on the table.
That might look like based on each of these concepts that you're promoting or presenting. You're not promoting it. Alternative one is a minor promotion, but to me, I look at this and I say, okay, alternative one in the settled period, which we are in now, more settled than 2020 to 22 for sure. What would have been the production of each of these graphs in dollars and cents? And the other would be, what is a projection or an estimate of 2026, 27?
Yeah, that let me just go over the hood. What's in here as we've snapped in for these replacement managers we've used kind of the median manager performance there. I guess what I would caution against kind of taking these over interpreting the returns, because the reality is the returns are that at the end of the day you have to have some sort of philosophical view that we think active management is productive in this space, right? So do we think the coin is loaded in our favor, right? And if we think the coin is loaded in our favor, it probably makes sense to do a couple things. A, to be invested in that, but then not just have one active manager, but have like 3 or 4 in the sense if we're flipping a loaded coin, let's flip the coin multiple times, giving us a positive experience. That if we're to quantify these things, let's say, for example, if your plan could add half a percent alpha a year after fees, right? So if we're talking about your current allocation of there's $175 million allocated to international equity right now. So if you do the math, that would be $875,000 of an additional returns that accrue to the portfolio. So yeah, on an annual basis.
So I, back to my question on these graphs. Can you calculate, if you took the data in this graph, to say what the end game was at the end of the graph? When you obviously you look at it, your alternative one hits above the index, and our current situation hits it on the money. But then you got to account for those drops in that green line for sure. So what is the end value of the ups and downs of core index alternative one based against the index? It looks to be positive.
Yeah,
So if we just dumped Harbor like 2019, we might not be having this discussion.
That may well be the case, right? It's hard, right? Because what we're saying is collectively as a pool, we think that international equity is a fertile place to add value, right? You saw the peers. The challenge is that the specific manager you had did poorly and dragged the whole thing down, right? So it's a philosophical decision, right? If you believe in the category, then it likely makes sense to replace this manager with another manager, right? But if you don't have belief in the category at all, then it gets to Dan's point in terms of indexing being the logical alternative.
Mr. Reveles, did you have a comment?
I just wanted to mention again that the board shouldn't be thinking about this, and John's mentioning it, you shouldn't be thinking about this in terms of dollars and cents lost in the past. It's happened. It's over. There's nothing that we're going to do about that now. The question is really going forward, what do we expect? What do we think? Do we believe, like John's saying, that there's value in active management in an international allocation? That's sort of the highest level. And if we think that, then, you know, we sort of can talk about the secondary steps, but that's really the first question that you want to answer to yourself. This slide on page 18 shows our green line, looks like quite a wave, and we can sort of smooth those waves out with these other alternatives.
Right.
And, you know, risk-averse investors prefer to do that. So that's really the first question you have to ask yourself is, do we believe in active management here in the international space?
Trustee Jardy.
Yeah, so my point is, it's not that there isn't somewhere out there in the universe some good active managers. It's my contention that the information given to this board, the deliberations by this board, we are not in a position to know whether we have them prospectively in our portfolio or not. Retroactive, looking in the rearview mirror, we can see in many cases we didn't. And so my problem with alternative one is we go from 6 funds to 8, I think. So we go, even though we eliminate two large cap funds, we add in 2 additional, just sort of other funds, and then 1 additional emerging, and then 1 additional small cap. So we actually eliminate 2 and add in 4 more, if I'm reading that correctly. You're proposing a second new small cap manager, you're adding a second emerging manager, you're adding a new value all world manager, and you're adding a new core manager. So is that going from 6?
It's going from, should be going from 6 to 6. So so the number of active managers is reducing from 6 to 5 because we're adding the index fund, which would be 40%. Yeah.
So we're adding more. So are any of these funds? These are all active funds.
No. In alternative 1, they're replacing the 2 active managers with an index fund. So when you see the last line under developed non-US of the MSCI World ex-US Index, they're replacing Harbor and Oakmark with an index fund. So you're replacing 2 active managers with 1 index fund. Then in the all world ex-US space, they're keeping 2 active managers, but they're just swapping one of them out. And they are adding a new manager in the emerging markets with no change to the number of managers in the non-US small cap section. And I apologize, that was not my place to.
You explained a lot better than I did, to be honest, so I appreciate it, yeah.
So this chart would be more helpful if there were some cross lines showing which ones you're getting rid of and not just.
It's there by using the faint,
the numbers.
Yeah,
the fainter
zeros.
font, and it's shown as zeros.
Yeah.
So if you read across like Harbor International in the current, it's in bold 35 million and 20%. In alternative 1, it's going to 0 and 0%. And that font is a light gray. So the one that has an allocation to it in that section is the MCSI World ex-US Index that now shows 70 million with a 40% of the overall allocation, where it didn't have anything assigned to it before.
Oh. Charlie.
Thank you. Just an observation about picking managers. 6 or 8 months ago, looking at these charts, I would love to have kissed off 91. Horrible, horrible 1 year, 3 year, 5 year performance. Why did we have these? And guess what? This last quarter, they were one of the best. But in that particular case, it looked like over the 3 and 5 year periods, they were a horrible manager. I'd rather get rid of them than Proven, Harbor Oak, or Oakmark, but they're in different classes. But that's it's not the style that's important. It's the manager itself. If we're looking at active management, so that again, 91 was just horrible. But I recall his comment that we're looking at India. Golly, it turns out for the last 6 months, India was the best place to be, and who knows whether it will be in the future. But they may be redeeming themselves, or maybe not. They might have just, guessed right.
Madam Chair.
Trustee Cromer.
Thank you.
I'm sorry.
So again, not focusing on any single data points, but we were on page 18, if they can scroll to that. I'm personally, to answer Robert's question, I do believe in active management in this arena. I think it does offer a benefit, but I'm also looking at the alternatives. In my perspective, alternative 1, I'm viewing as a tweak, a slight tweak, and I'm viewing alternative 2 as an adjustment, and I'm viewing alternative 3 as a bail. I mean, that's the only way I can word it.
That's a fair way to characterize it.
It's we're popping smoke and we're leaving.
Yep.
So what I'm looking at on this specific chart, again, I'm not trying to narrow it down to this specific one data point, but I'm personally evaluating alternative 1 and alternative 2 as my preferences, and I'm trying to compare the two of those. And on this specific chart, I still see quite a bit of volatility in alternative 1 that I don't like, because the highs can be slightly higher, but the lows are much lower. And I look at alternative 2 as a much more smooth, clean ocean with less waves, with almost the exact same result of performance and experience for our fund. Am I assessing that correctly, in your opinion?
Yeah, maybe flick one slide back.
Page 17, yeah.
Yeah, so these are the tracking of the different portfolios. So, and again, this is exactly what you said. This kind of stability of the ride, if you will. That you're exactly right. That the Alt 2 has less volatility than Alt 1. In terms of, and again, I kind of caution you. I mean, I wouldn't put too much weight on that historical experience, right? Because we're putting in the performance of a typical, kind of the median manager, if you will. We don't know what's going to happen forward looking, except kind of the caveat we set upstream that we believe that in terms of fishing ground, that international equity is a better space. It's more fertile area for active management. That I would say other things equal, that the Alt 2 in a forward-looking sense would be likely to produce less alpha over time, because again, it's taking fewer bets, because that track carry measures how big a bet you're making. So if you're only making you can see it's kind of making 2/3 of as big a bet. You see how it's kind of 1.2 versus 1.8 in terms of the tracking error. So if the managers outperform, you'd expect to do a bit better with the Alt 1. But again, and I apologize. I mean, it's inherently ambiguous, right? The one thing you can control is that risk, right? So
I think there's a little more simplicity offered in alternative 2. It's a little less complex too, which
agreed.
In my experience on this board, I think that we've gravitated towards a little more simplicity, because when it's more complex, and the fees are the fees. I believe in active management here, but the simplicity is another aspect of alternative 2 that I am preferring personally as a trustee.
Yep. Understood.
I would like to comment, when you're looking at not just the return chart, but also the chart, I think it was on 17, regarding the tracking error, again, I'd like to stress that those are based on like an average for that particular type of class or manager, and it will be highly dependent on the specific manager that you hire, but you would want to address tracking error if you chose to hire an active manager in any of those spaces to understand their style and how closely they choose to deviate from that, because those are averages in those slides, correct?
Yeah, for full clarity, that when I created the replacement managers, I tried to intentionally select managers that had that typical tracking errors, those styles. So again, Oakmark is kind of the outlier, right? Oakmark by itself has a 10% tracking error, whereas most managers have more like a 3 to 5% tracking error. So in terms of snapping in these new managers for the tracking error, I guess what I'd argue is I think these are pretty good representations on a forward-looking basis of what you would get, And again, in the search process, that part of that would be, hey, we don't want another manager that has 40 stocks and has run super high tracking error, because in the search process we can select for the level of tracking we want. Yeah. So again, I would put a lot more. Yeah, the tracking error, I feel pretty comfortable with those numbers. Yeah, no problem.
Trustee Jardy.
So I very much appreciate the comments and position by Trustee Comer. I think alternative 2 is more in keeping with the direction the board has been trying to go, which is to simplify the portfolio. I also think looking forward, I think the board can maybe focus more on the performance of what would be 2 smaller bets on 2 smaller allocations to emerging markets. Well, essentially would drop our bet on active down to 33% or 37% versus right now 100%. And so, but also by having a second emerging market bet, it diversifies the emerging market managers potentially. So one with one approach could potentially be balanced out by another manager with a different approach. So I think alternative 2 is much more, I think, in line with the information that this board has historically received and its capacity to make a decision about good managers. And I think it's reducing the bet down to 37% of the international portfolio, and I think that's more in line with, I think, our capacity as board members.
Through the chair, my concerns with alternative 1, I'm still considering that a tweak, and I don't know if that is enough of a change in response to the performance over a long period of time that we've experienced. And that's my concern with alternative 1, is I do view that as a tweak, but I think the performance warrants a bigger change based on what you've shown to us and you've proven to us that I might not be looking for a tweak here. I'm looking for more of an adjustment personally because of the poor historical performance of our current investment in this arena.
I think that's reasonable. I think what I really like page 4 study, just thinking about things from a philosophical perspective. Bottom half tries to outline what each alternative says, kind of philosophically. One proposes 40% national portfolio and putting that in an index, right? Passive index with active management. This proposal is, and to your point, diversifying the management category. But focusing on alternative 2, as we outline on the bottom of the page, what does this structure say? It says active management not pay developed markets. Structure is that belief. It for active risk or alternative 1, is certainly less of a change than alternative 2. 40% into an index fund is a meaningful shift, so I think alternative 1 are worth considering. call it more than a baby step out of active management, but
Mr. Rivelis?
So I just want to mention also for the board that we're looking for direction on one of the alternatives, and we would be bringing back, depending on the alternative here, so potential new managers in a few months here. Callan would do a search. If we went with alternative 2, we'd have a small cap manager recommendation and a new EM manager. We'd also have the index recommendation also, because there's multiple index funds.
Trustee?
So in examining new managers, that's next to existing managers except one, would that be what came back? We just, Harbor would be out of the picture and bring somebody in for replacement, or a couple options for replacement? Would you also have options for replacement for the other managers that aren't being removed?
yeah, so each of the alternatives here, the next step would be a search. Each one involves a search. Starting on the far right, alternative 3, obviously all index, but alternative 2 would require a search for index funds, also a search for another complementary markets manager. 3 searches in total. Alternative 1, a search for national value manager. That's Mondrian would certainly be included in that search. You can evaluate your existing side, but that's the proposal there. An index manager search, and then a search for another.
Trustee Shoemaker, if I could clarify, was your question, for example, if we were looking at alternative 2, if it would be looking at potentially 2 managers to replace our existing one with 2 new ones, as opposed to keeping the existing manager and adding a new emerging market manager? Was that your question?
My question was, is everybody in the bucket? I put it that way. Is everybody on the stand to be picked or rejected, including the existings? So each category will look at our current and look at new, right? Does that make it clear for what I'm asking about?
The way it was illustrated was retaining the international small cap and the existing international emerging, but it's certainly not beyond scope that we could have them look at replacing, all of the managers in that, as opposed to just adding one. So but that would really be more for board direction.
Yeah.
But the way it's illustrated was retaining the 2 managers we have in those 2 particular spaces, but adding to them. Fair to say?
Thank you. That clears it up for me. The 2 other comments. My comment about taking that graph and assigning an end dollar value to it was meant to compare it to what Dan is talking about, because he's talking dollars, and if that has a end dollar, so be it. I totally understand that isn't playing the backwards look in game is not how we make our decisions. So the other thing is Charlie's comment about 91. I thought that was very interesting, but it also brought up to me, every time you go to a conference, they talk about different regions, different countries, and India is on an upswing. And are these guys going to go through the roof in the near future or not? Or is it India politically charged as well and going to fall apart? But it's interesting to me how we've so simplified it to we want to put our money in the bank, so to speak, but be at A and not worry. That's kind of, to me, what everything in an index fund is, so to speak. I like the concepts in both 1 and 2, and I think 1 is a good step. It's changing what we're doing, but I wouldn't argue heavily against. 2.
Trustee Comer.
Madam Chair, I'd like to make a motion to approve alternative 2 and give direction to staff and Callan to come back and return with options for the board to consider within that alternative for all of the active managers and the index fund.
Ooh, all of them.
Is there any discussion on the motion?
Who is the second?
Charlie.
Trustee.
I had a couple of questions about alternative 2, and I guess alternative 1 as well. Both of them have significant new investments in emerging markets, and alternative 2 seems to jump quite a bit, up to 27% of this whole sector. Is there a reason that we arrived at those numbers? Or, they seem pretty random. I mean, how did we get 63, 27, 10?
Yeah, sure. Let's focus on alternative 2. Remember, your all's overall benchmark is the ACWI ex-US. That's composed of roughly 70% developed markets, 30% emerging. So in alt 2, what we're saying is philosophically, let's don't do any active management in developed markets. Okay, and so that's what.
If we approve option 2, would these be locked in, or would we be able to further negotiate the different allocations? I guess that's a question for the board, or anybody who can answer it.
I think you could clarify, am I on? I think you could clarify alternative 2 and say, you know, we're not locking into these percentages, bring that back as well, and you can certainly do that. Is that good enough direction for you? You don't need to know the specific numbers, right? Yeah, that can come later.
Yeah, but I guess
in general.
Just qualitatively, these have been constructed such that when you add up all the pieces, that alt 2, you end up with 70% exposure to developed and 30% to emerging. So that's why the numbers look the way you do, because when you add up all the pieces, you're not making a bet on emerging or developed.
It aligns with the benchmark in that regard. So you're right, you're taking away that bet that you think, oh, maybe developed markets are going to do better, or maybe you want more in emerging markets because you're going to follow the same alignment of how much is developed and how much is emerging that we use in the benchmark that we grade ourselves against.
Good.
Your current active managers have some allocation markets, so that's dedicated.
Right.
Trustee Jardy.
That was my question. My understanding was that some of our active managers who aren't specifically emerging market already had an allocation to emerging markets. And so I guess I wasn't clear, but is our current target something in the neighborhood of 30%? If you look at the entire portfolio in emerging markets, it's just not 30% allocated to a single emerging market fund.
Spot on.
Yep.
Trustee Shoemaker.
This category of investment against the large cap, et cetera, does it require a more active watch on an annual basis than being in a large cap fund? That's an obvious answer, I think. But is this something that we should be looking at more closely, more frequently?
Could I ask, do you mean
Performance.
international versus perhaps domestic?
Yeah,
Does international
yes.
require more
Yes.
oversight?
Yes.
Okay.
I think we maintain a close watch on all of your active managers, the entirety of the portfolio. You're delegating active managers, these active managers to. Sorry, not close enough. Apologies. I think they all require active oversight. So, you're delegating responsibility for making those active decisions versus a respective benchmark, and we monitor every single manager versus their benchmark.
Okay.
Is there any further discussion? Is there,
I guess I
Mr.
would
Rivelis?
also sort of say to that, we would just have less managers coming in to give education and bring updates.
Is there any public comment?
There is no public comment.
Would you please do a roll call, Judy?
I thought this was board direction only.
No, there was a
we had a
motion.
Mr. Kelly? Ms. Cavanis?
Aye.
Jurdy?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
No,
Oh, I'm
can't
sorry.
vote.
I'm sorry. Ms. Pierce?
Aye.
Mr. Land?
Aye.
Thank you.
Thank you.
Yeah, thanks very much. Good to see you.
Anything else for us?
Thank you very much. Really appreciate it.
Thank you. Great to see you all, and I think we've got our direction.
Okay, next we have, real estate characteristic review with Mr. Reveles, retirement financial officer.
Trustees, you have the memo and update report. I'd be happy to answer any questions. I think there's only one thing I guess I would point out here when it comes to the sector, the occupancy exposure here. Just in case anybody was sort of highly concerned, I guess, about the office exposure here on Barings, there is a significant drop that you can see here. And part of the reason for that drop is because Barings is working on getting out of the central business district sector. They're actively selling their buildings, and they've got one more building left that's heavily impaired in the sector set for sale. And so next month, we're going to see that occupancy by sector sort of kick back up into the low 80 percentile range. So that's really the only additional thing I wanted to point out. I briefly went over what I think is going to impact the 10-year yield, which has a huge bearing on appreciation returns in the memo, and I'd be happy to answer any questions.
Is there any discussion? Okay, thank you. So moving on to agenda item 4, fiscal year 23-24 and 24-25 budget updates. Mr. Reveles?
Did we need to just mention that item 3E was the monthly performance report? And if you had any questions on it, take any questions, but it was just the monthly report.
Yeah, I thought, because it said Callan, that it was a Callan item, but Mr. Reveles?
And they're there if need be, but.
Yeah, it's just a monthly report. We had a good month. Almost 2.4% return net of fees for the month, and we're about $730 million.
Very nice. Okay. Moving on to agenda item 4, Mr. Reveles.
Trustees, you have the preliminary quarterly budget update for the fourth quarter fiscal year 24, memo and reports. Happy to answer any questions or concerns you have.
Okay, seeing none. Is there any public comment?
There is no public comment.
Okay. So moving on to agenda item number 5, succession planning process, Director Rentschler.
Thank you, Chair Kapnis. Judy, if you could run the slides for me. If we hop to slide 2, I would just like to give a brief overview of the succession planning process, what its objectives are. And really, this is a tool for the board to prepare for the future by outlining a process for identifying, developing individuals to replenish existing talent when roles become vacant. So it can help employees by identifying the skills they may need to gain in order to advance. And it provides the board with a clear path for some organizational stability. So the traditional 6-step process for succession planning looks at retirement eligibility of people in different roles, identifying critical roles of the organization, creating a chart, candidate profiles, developing a coaching plan to develop internal talent, and even identifying, a compensation survey aspect of it. However, if we jump to the next slide on slide 3, there are some shortcomings of the traditional succession planning model, and that is that it primarily focuses on identifying, developing internal candidates, which is very difficult for an organization as small as MSERA with a total staff of 6, counting myself. So we don't have the opportunity to develop a extremely in-depth internal bench of candidates. And so there's also no opportunity to coach external candidates that you might consider. So it adds a level of complexity when you're trying to do succession planning for an organization as small as ours. Additionally, the succession planning model focuses on planned transitions like retirement to permanently fill transactions, but MSERA's greatest risk is likely from unplanned events, whether that's a temporary leave of absence due to illness or whether it's permanent. So we have both absences and vacancies, and I use these terms to distinguish between a temporary event where we would expect the incumbent to return to service versus a vacancy where the incumbent is not expected to return. And an absence can turn into a vacancy because someone may not return from a medical leave of absence or something like that. Now, vacancies could be filled on an acting or an interim basis based on the needs of the organization, desires of the board. So when we plan for events, whether they are planned or unplanned, so even if it's an absence, that could be planned for. I know I'm going to need surgery and I'm going to be off for 6 weeks. It's a temporary event, so it's an absence, and it's something that we can certainly plan for because it was scheduled in advance. Versus I get hit by the bus and I wasn't really expecting that, so then you have an unplanned absence. So it applies to both vacancies and absences. They can either be planned or unplanned, and it's important that we know how the organization would react in both sets of circumstances. So part of the policy that will be put together will address those. Part of that is working out of class and using acting and interim appointments. So this is based on County Policy 41 and gives a description of what it means to work out of class or an acting assignment. Now, Policy 41 does not cover interim appointments, but there can be an interim appointment in some instances. Generally, if you are having an existing county employee fill in, we're going to call that an acting assignment because that allows that employee to return to their existing position. Whereas an interim appointment, if someone is interim appointed, they don't have any job to go back to. It creates a vacancy in the job that they held if they were a current employee. So under the succession planning process for MSERA, I've modified it to provide the following 5 steps, which is identifying the critical roles that need to be addressed and identifying the essential functions that those roles provide, and developing different succession strategies to address different needs and different events. identify prospects and sources of candidates to fill those critical roles, and those could be internal candidates, they could be external sources and prospects for candidates, or doing a full recruitment in the event of a permanent replacement. Part of the process in developing a succession plan is being prepared to minimize any disruption of essential functions if you have a transition in a critical position. So part of that is built into our plan, what we plan to do in order to minimize the likelihood for any disruption of essential functions. It also establishes processes and guidelines for coverage and transitions. And the last step of that planning process is a routine monitoring the plan and updating it as necessary. So step one has to do with the critical role identification. So on slide 8, we have 3 roles listed. These were a combination of the evaluations that I asked trustees to complete. It does not reflect every aspect that or position that trustees included on their own evaluation of what they thought the critical roles were, but these were the most common and significant ones. So each role was evaluated based on urgency, impact, skills, available internal talent, external talent, and developed a total point ranking. And the total points then became the basis for the prioritizing of how to address it in the policy. So next month, I am, depending on the conversation that occurs today, I'll finalize the policy that has been mostly drafted, and we'll bring that back for the board's consideration at the September meeting. So urgency was a discussion of how quickly someone thought the role may be vacated. And that could include things like retirement eligibility. Impact is how much of an impact it would have on the organization, whether or not the role requires specialized skills or knowledge is reflected in the skills rating, whether or not there's any internal candidates available, and the likelihood or the extent of being difficult to fill by external candidates are the last 2 columns there. So these were all rated on a 1 to 5 basis, and these numbers represent a consensus of the responses received, including my own and Robert's and even Jeff's opinion in those critical roles. Step 2 of the process was to identify prospects and sources. So this could include a review of sources for candidates for each type or each critical role that is addressed in the policy, and include some suggestions for development of staff in the organization to make it more robust and able to weather potential changes in those critical role positions. The process includes identifying internal positions and options that may be available externally, the advantages and disadvantages of each. We look at whether or not it would make sense to use particular candidates, whether internal or external, based on whether or not it's a absence or a vacancy. The following slide 10, step 3 talks about what we've done to minimize disruptions in the event of an absence or vacancy. And it's really to ensure that staff are cross-trained on all essential functions and that we have process and procedure documents drafted that are available to assist anybody who has to perform an essential task. But we're also doing that cross-training to give people exposure to it. So the first time they sit down to do it, it's not just that they have the written instructions. They've had experience doing it before because they've shadowed the person who does that on a regular basis. Slide 11 talks about the process that would be involved in the policy. It defines responsibilities. It talks about cross-training, the differences in absences and vacancy procedures. addresses acting and internal compensation for those appointments, internal and external candidates. Powers and duties that may be afforded to someone in an acting or interim capacity, and promotional and recruitment discussions as far as part of the process for critical roles. The last step on slide 12 is just review, monitor, and update. So certainly as circumstances change, both within and outside of MSERA, information regarding sources and potential candidates will become obsolete and will need to be updated. So I'll provide an update periodically to the board on the status of the succession plan. And we have of course, our standard policy review, that the policy itself would be reviewed every 3 years or more frequently if the need arises. But the periodic update from me would just be a discussion about, changes in potential sources of candidates and things of that nature. So if you have questions regarding the process that I put together for use in developing the policy, I'm happy to address those now.
Trustee Jordy.
Well, first off, Doris, thanks for putting the effort into this. Right. I mean, we've all seen so many people at the county come and go, and they don't put this kind of effort into thinking through succession planning for their organization or their department. I know this is not a department, but correlating it to other county departments. But the other thing is, and this may not apply to MSERA because of the size, and the distinctions between the job classifications in MSERA are so vastly different. But I am aware that at the state of California, at least in larger state agencies, that they kind of encourage temporary assignments, and I think it's very different from what I've seen at the county, in that someone may have it's advertised, it's recruited internally as a 6-month assignment. The person knows it's a 6-month assignment, and so there's no shame if they decide, this wasn't a good fit for me. I don't want to apply for the permanent job. I'm going back to my old job. It's also maybe the department decided it really wasn't a good fit and they moved back. But again, no shame. I've seen at the county where sometimes people get promoted and it's not explicitly advertised in such a strong way as a short-time assignment, and then suddenly, oh, this person's a failure. Now the next thing you know, they're not even a county employee. And, well, they didn't suddenly become a bad employee. It just wasn't a good fit. And so, anyway, so I don't know, given the size of MSERA and how the different positions are so vastly different from each other, that you could have an internal candidate take a temporary assignment, but perhaps that could be done. But I think the state's model of the temporary assignment, where the person could easily move back to their old job, again with no shame, is better than what I've seen at the county.
That's an interesting concept. I haven't actually seen it used where I've worked, which have been counties and cities. But that does bring a new avenue potentially to evaluate someone in a position where they're not necessarily truly giving up their rights to their old position. Although in general, most places do have a bump back. So if I didn't like it or didn't pass probation, a lot of times you're allowed to bump back. And then, of course, that bumps back the person who may have taken your position. And I'm assuming that that's something that the county does, but I don't know because I'm not that familiar with county HR practices. Because you're right, our organization being so small, I think that would be more difficult to implement. But I think what we can do is just give our employees a slightly broader set of assignments to give them opportunity and exposure to different areas so they have a better understanding of how the organization functions as a whole and what's required of a specific job that would help prepare them should they decide that they want to move into a particular direction within the organization.
I just wanted to say that, yes, the bump back is something that happens here at the county. Absolutely.
Did you have a comment, Mr. Shoemaker?
Sure. The executive director will review and update sources of potential candidates at least annually, etc. It's an interesting concept. Is that, I mean, one thing that comes to mind for me is that somewhere everybody has a list of all the high-level employees at all the other CERLs in the county or in the state. It's like, oh, here, look at this person as an assistant at this level. They might work over here.
So that's actually part of it, is identifying prospects who may be willing to serve on either an interim basis or a permanent basis. And it's looking at people who maybe are retired but would be willing to come back to cover in an interim capacity while a full recruitment is done. It also might be working with a recruiting firm who has a lot of tendrils out into the retirement systems in California as far as that market, and might be able to reach out to folks. So there's a variety of different avenues that could be taken, and all of those are part of the succession plan underneath it. It's not baked into the policy, but it's something that, the executive director position needs to identify those sources and prospects. So if there's an event that occurs, and it's not just my position, it could be Robert's position, that we have perhaps a way to quickly address the need, because we're so small that we can't really leave something, a position vacant for a while we do the search, that we can act on quickly to make sure we maintain a minimum level of performance of the duties while we address it in a slightly longer term basis, whether that be an acting appointment or full recruitment, depending on the need of the organization, the type of vacancy.
Thank you.
But just following up what Richard said, he might perhaps was referring to, like with cities, there's sort of a pool of retired city managers who are available to serve. I guess it's a little different when you got 450 cities in California and you've got 22 CERLs.
20.
So anyway, so it may be a different industry in that there may not be that pool of people out there, but maybe there is. I don't know.
The pool is smaller, but I've spoken with a variety of folks to just see, would someone be even interested in bringing in their skill set to cover a short-term need while the board took action to, let's say, fill a permanent vacancy that could take 3 months. You have to hire a recruiting firm, and then you have to do your selection and interviews, etc. So you want someone to perform and provide some leadership to the organization while you're performing the rest of those functions.
Is there any further board member discussion on this? I also just want to thank you so much for tackling this difficult and challenging area, and it is so crucially important to keep an organization running successfully. Yeah.
So I did have this down as board direction. So if you had any strong feelings on something that should be included in the policy that perhaps I didn't touch on, I'm happy to take any feedback. Otherwise, I can bring the policy back at the September meeting for a first read, and you'll have the opportunity to make any recommended changes to the draft policy at that point in time.
Is there any public comment?
There is no public comment.
Thank you. Agenda item number 7, new trustee orientation program, Director Rentschler. Oh, sorry. I can't. Yeah.
Thank you, Chair Cavness. So there have been some board discussions in the past regarding trustee orientation and what has been done for it. Now, our trustee education and training policy, I believe, states that we need to have a formal board orientation. So this cover memo summarizes the attributes that would be included in that formal policy. So for comparison purposes, I provided an example of what a orientation day would look like. It basically would be a full day. It could be split to be done over 2 days to make it a little more convenient potentially, but it covers everything from board administration, governance, an overview of our regulations and charters, Brown Act compliance, Public Records Act, the consultants that the board reserves the right to hire, things like attorneys and investment consultants and those types of service providers. It also includes overview of MSARA's benefits, so new trustees would understand that the benefits the system provides, and an overview of the disability process, along with, again, a discussion on accounting, budgeting, financial statements, the actuarial process, a review of our valuation, experience studies and risk reports, and an overview of the investment program, including our asset allocation and the quarterly investment performance. So a while back, we had developed a new trustee handbook that is provided in this packet of materials following the trustee orientation schedule. If you go to the next page, you'll actually see the new trustee handbook. That handbook is about 10 pages long and covers a variety of the information, including the history of MSARA and the role of the trustee and their fiduciary duty. Beyond that, if you skip down to probably be about page 12 or 13, it actually goes into the actual presentations of what would be provided to a new trustee at the orientation for those first 6 topics, I believe, that were on the agenda. That information is there just so you can see the type of information and extent of information that would be provided to trustees. And there's, 100 and some odd slides here. Just to show you the comprehensive nature of the program that has been put together as a formal process. The information is there really just for your reference, but because this is to be a formal program of the board, I believe it requires board adoption. Is that correct, Jeff? Or is it just the board says, yeah, it's okay? So I think I actually had the recommended action as adoption of the new trustee program as presented. If you see something that you think should be included that has not been included, as far as that agenda is probably the easiest place to look at to see the topics being covered, please let us know, and I can certainly incorporate additional information into the orientation for new trustees. I'm happy to answer any questions.
Trustee Shoemaker.
How about like SB 553, trainings, violence in the workplace, harassment, that stuff required for us?
It touches on some of those requirements, but it isn't necessarily provided. Some of those have to be given by like a certified source or something, but we do have sources available for the fair practices requirements, the ethics, the anti-sexual harassment, etc. Often those are available through both SACRs and calipers, so there are sources we have available. They are not part specifically of this orientation, though.
Well, you might not on the agenda so much as the cover sheet, because at some point you need to take those things.
As part of the review of the educational requirements, I believe it's mentioned in there, but I will confirm that. Because we talk about the 24 hours every 2 years, and I believe it mentions the ethics and the other required trainings.
Madam Chair. Doris. Developing board on your
Is there any further discussion? So we don't need a motion, correct? We can just,
I had it listed as adoption, but if the council says that's not needed, I'll defer to council.
You can take a motion and adopt it, sure.
okay, is there a motion to adopt?
Move to approve the new trustee orientation program.
Is there any further discussion? Judy, please help us take the roll call.
Trustee Kelly? Trustee Cavanis?
Aye.
Trustee Jurdy?
Yes.
Trustee Cromer?
Aye.
Trustee Shoemaker?
Aye.
Trustee Harris? Trustee Pierce?
Aye.
Trustee Land?
Aye.
Thank you.
And I'm sure you all appreciate I didn't run through all 128 slides for you.
You would have trained us.
Huh?
Do we want to take a break? Are we ready for a break? So we'll be back at 11:05.
Okay.
Of strength behind me.
If I didn't have those resources that Jeanette provided me, I think it would be harder now.
I got into the program and I realized, like, oh, this is nice. And now look at me, I work at a family resource center with parents and families, all this stuff.
I'm so grateful that I got the opportunity to meet my home visitor, because without her, I think that I would be 10 steps behind from where I'm at right now.
Pero pues aquí pues ya los enseñan un poquito más cosas que uno no sabía. Cómo cuidarla, cómo desarrollarla, cómo educarla, y pues es algo bien, porque pues cosas que yo no sabía, pues ya usted nos las dijo y todo como consejos, y pues muchas cosas que se aprendieron.
I don't know what's normal for a 22-month-old baby or an 18-month-old baby, you know. When we get together, we usually discuss and get some progress made with the baby. It makes me feel comfortable, and I associate my parenting with her, my home visitor, telling me, yeah, this is going great.
So it's nice to know where they're at, what stage they're at for every parent, and also to give, again, your children that head start in education.
If I had any questions with her, just call her up on the phone. You know, it was very relatable, very personal. And, you know, with her getting to know my kids, you know, she got to kind of help guide me along the way. I mean, there were so many cool things that I've learned.
I went from a very rough type of life. I was homeless, and she was able to help me get into school, and I actually have enough credits to graduate with the business degree right now.
I think I really want to mention just that I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
I want other people and parents to know that the home visiting is not something that you should be afraid of. It's actually something that is needed.
You know, because she's not just here for her, she's here to help with all of it. She helped me create a safe space where I feel comfortable enough to ask for help.
Don't be afraid to take that step. Like, don't be afraid to get help. It's always okay to have extra support.
I suggest that I would say, give it a try. You got nothing to lose. It's free. There's some perks, you know. They got great resources.
Personally, I think everybody could benefit from the home visiting programs.
I realized that my life was going to change dramatically in ways that I did not know or understand or even comprehend. I was going to have to really go to the well and become accountable and adjust to a lot of things differently.
Que queríamos era que naciera, ya, sí, ya quiero tener, entonces ahorita lo que tenemos es aprovecharla, quererla y cuidarla lo más que se pueda.
Creo que a todos nos preocupa la primera vez que nos dicen que vamos a ser padres.
When we started the program, my daughter was about 3 months, and my daughter's 22 months now. Something I love about my child, that she's healthy, she's happy, she knows that she's cared for and loved. Those are some of the things that I wanted to make sure that she had, and she has them.
I'm happy today with my daughter. She's the greatest thing in my life, and I'm glad to wake up and see her, and everything I do it for her.
Sí, bueno, yo también vengo de una familia separada. Creo que por eso también me motiva a estar más presente con él, de quizás también estar de la forma quizás que yo no la tuve para Máximo. Y también comprender que el padre no solo es el que pone los límites y las reglas, sino que también está ahí para hablar, acompañar, regalonear, jugar, cosas lindas también, no solo ser el guía para el niño, sino que también un compañero de vida.
I was more of a elated and thankful because for 3 months I was in baby land, and when you're in baby world, you're just kind of flying by the seat of your pants and hoping you know that you're just supportive in the ways that you can be supportive.
Pero pues aquí pues ya los enseñan un poquito más cosas que uno no sabía, como cuidarla, cómo desarrollarla, cómo educarla, y pues es algo bien porque pues cosas que yo no sabía, pues ya usted nos las dijo y todo como consejos, y pues muchas cosas que se aprendieron.
Bueno, creo que por mi parte esperaba algo totalmente diferente, como un programa más frío, por decir algo, no tan cercano a la familia, sino más bien un programa de estado programado para la ayuda solamente. Y a través del programa nos hemos dado cuenta que también pasa a ser una familia con nosotros, porque nos apoya en los momentos difíciles o cuando nos hemos visto en dificultades. Siempre nos hemos podido apoyar en Gaby a través de su programa. Encuentro que ha sido fundamental el apoyo.
You know, my experience has been nothing but positive. Annette has been wonderful. She's on time. She lets me know if there's going to be any changes in the schedule.
Not only did we get the assistance with this program, but we also made a really good friend. I'm happy to call Gabby our friend.
I still feel the challenge of being a parent now in today's world is immense. I think that you need support.
Es un gran apoyo para nuevos padres, y más aún si están en nuestra situación, que somos extranjeros, que nuestra familia y amigos, como dice Carla, están en otro país, lejos. Entonces sí, viene muy bien el programa para apoyarse tanto emocional y como anímicamente, y bueno, en varios aspectos del programa que nos ayuda a seguir adelante con esta nueva aventura.
Don't be afraid to take that step. Like, don't be afraid to get help, because, you know, you might think that you know what you're doing, but it's always okay to have extra support, and don't do it alone.
Give it a try. You got nothing to lose. It's free. I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
Are you prepared? We're the Office of Emergency Services, and we're committed to providing the most up-to-date and accurate information so that you and your family can stay safe during an emergency. Part of being prepared is knowing your hazards and taking proper precautions. Visit mendoready.org. On the Know Your Hazards page, you can find hazards for where you work, where you live, and where your kids go to school. On the Plan and Prepare page, you'll find a plan template. It's important to know what you're going to do, what you're going to take with you, how you're going to communicate, where you're going to go, and how to get there.
One great way to prepare is to pack a go bag. Each member of your family should have their own go bag. Visit our website, mendoready.org, to get a list of items that should be in your go bag.
Gathering and organizing important documents before an emergency is an important part of preparedness. So visit mendoready.org today, where you can find a list of important documents that you should have ready near your go bag in case you have to evacuate.
Not every emergency requires people to evacuate. An emergency kit will have supplies for you to remain self-sufficient for 72 hours. Find a list of supplies for disaster kits on our website, mendoready.org.
A prepared community is a resilient community that will recover faster from disasters. So take some time today, visit our website, get yourself prepared so you can be Mendo ready.
Personally, I think everybody could benefit from the home visiting programs.
I think that as a parent now, I'm grateful for support more than I was before.
I filled out that form not knowing what I was doing. I am very, very grateful that I did it because it's really helping me a lot.
Bueno, creo que por mi parte esperaba algo totalmente diferente, como un programa más frío, por decir algo, no tan cercano a la familia. Y a través del programa nos hemos dado cuenta que también pasa a ser una familia con nosotros porque nos apoya en los momentos difíciles o cuando nos hemos visto en dificultades.
Well, I was a new mom and I had no experience taking care of a newborn.
There isn't like a book on how to raise a kid.
We come from like a lot of family history of, drugs, violence, alcoholism, so we didn't want our daughter to experience any of that.
The thought that a parent was supposed to be loving, nurturing, supposed to be there for their kid, provide food, shelter, joy, and going in, becoming a parent for her, I had no clue how to provide that.
¿Cómo pensar educarla? Ajá. ¿Cómo educar a un hijo? Porque pues nosotros nunca, es la primera vez que íbamos a ser padres.
What I think parents should know about home visiting is that you can learn a lot of new things and tips and tricks, how to take care of the baby and what to do.
We're on agenda item 7, presenter Doris Rentschler.
Thank you, Chair Kavnis. This is an update to the board's strategic work plan. I did change the format of it because it made it a little easier, I think, for me to make changes as we add new strategic objectives and action items. Obviously, we have a 5-year plan. The 5-year plan didn't identify every single action item. They kind of build upon each other. So these include some of the things that were part of the original strategic plan, like the succession plan that was discussed today, and the policy will be brought back next month. We have a number of action items here, including some new items, especially on page 2, that talk about customer satisfaction surveys. Prior to my tenure, they did I believe, a survey of folks who actually retired, but we're looking at designing some survey instruments and doing more customer satisfaction survey. That is a follow-up to the membership survey that was done by Problonsky Research, which was part of the original tasks of the strategic plan. And then based on the information that's come out of that, we're going to be developing some customer satisfaction surveys, because now we have some sort of baseline metrics to base it on, and now we can build off of that. And then also part of that survey from Problonsky was how members wanted to receive information, and one of those was in the form of quick tip videos. So our goal is to create 3 quick tip videos during this fiscal year by June of 25, and we're going to have them cover topics on how benefits are calculated, understanding the different payment options, and using Member Direct. So in addition to the actual list of action items, because I have little check marks or X's noting which goal it relates to, I've provided, just for the board's reference on the following pages 3 and 4, a list of what the goals are and a list of the success statements that we have in our succession or in our strategic plan of what it means for goal 1. One of the success statements was that, the goal is to protect the long-term health of the plan. The success statement was that the plan is considered sustainable, that we're approaching full funding, etc. I also included on page 4 the actual objectives listed in the strategic plan. So pages 3 and 4 just summarize the goals, success statements, and objectives that are in the plan. Because I indicate which goal each action item relates to, this just gave you a quick way to go find it without having to go pull out your strategic plan, which I'm sure you all carry with you. But it's just put there as an easy reference. Whether someone else in the public is looking at it, they can look through and say, oh, well, this is what that goal is, and this is what it means if we're successful. So that's the new format of the board work plan. I also have a new format of the board rolling calendar. The rolling calendar now perhaps has less detailed information, but it is summarized in a way that's probably easier for us to maintain. So I apologize that you can't see it on the screen, but it is in your packets if you look at it there. It breaks in our rolling calendar based on whether it's specifically work related to the developing the strategic plan, whether they're board matters, actuarial matters, financial matters, investment matters, and educational items. So this just gives you an X in the month in which we would be bringing those things forward, so you can kind of say, oh, well, I know that we're going to see the budget updates and amendments on these months, or it's just a new way of looking at the calendar. It doesn't give you the specific educational topics, but just sort of lists what months we would expect those. As reference, the older version is on the pages following this, so you can see what I used to provide versus what I'm proposing we move to. But again, it's the board's preference on that, so I would actually like some direction from the board on the new formats, and if you're willing to move to these new formats, especially with the board calendar, because that's such a big change. And I'm happy to answer any questions if there are any of the board.
Is there any discussion? I really like the board strategic calendar. So
through the chair, I like both of the new documents.
I think they're actually going to be easier to maintain, so I would like to use them, but again, if there's information that the board wants that's not included in these, then we can look at altering the format or going back to an older version. But my my hope would be that we could move forward with the 2 new versions being presented.
Okay. Is there any other discussion on this? Is there any public comment? Okay, then moving on to administrative report, Director Rentschler.
Thank you, Chair Cavness. So I have a couple of updates. The board performance evaluation policy says that it shall be conducted annually or at a frequency as directed by the board. The last board performance evaluation was completed in the summer or fall of 2023. I would like board direction on whether or not the board wishes to complete a performance evaluation this year. There is a noteworthy court case out of the Court of Appeals, and Jeff might speak more to this, but the LA County Employees Retirement Association, La Serra, and the County of LA were involved in a dispute regarding the board's ability to create classifications and set compensation. And this went to the Court of Appeals. The Court of Appeals came down in favor of La Serra, indicating that they should have essentially final say in setting those classifications and compensation. I believe this has been submitted to the Supreme Court of California, but it hasn't been decided whether or not the court was going to take it up. Did you have any comment on that, Jeff?
This decision because it is possible that the California Supreme Court will review it, but it just shows and reminds us all of the significance of Prop 162 that the voters passed in 1992 that states that retirement boards like yours have plenary authority, and that means complete and absolute authority. And so, you know, there's always been a tension between these retirement systems that are independent legal entities and their relationship with the county. And but this is a very clear decision that salaries and classifications are to be determined by a board like yours. So I do think that's quite significant, and how it plays out when you have folks who may be in unions and subject to contracts under memorandums of MOUs, how that will play out is still a little bit to be determined.
Go ahead. So as we understand more about this, will there be something brought back in front of this board as to how it will affect us? Because I have concerns about, as a trustee, taking on labor negotiations and how that will impact how we interact with HR and other just labor negotiations in general.
We certainly would bring this back as more information becomes available if it is taken up by the Supreme Court. I don't think it necessarily has to go to the level of labor negotiations, but it would give the board more leeway in, let's say, defining a new classification of a position that we wanted to add, which I think was one of the issues that La Serra had. And truly, I think MSERA had that same issue when we wanted to develop what is now Robert's position as far as the finance investment officer, and were originally told, no, you can't have a position like that. So I think it gives the board more authority in that realm and some more authority in addressing potential compensation issues, but I might defer to counsel on that as far as your thoughts.
No, I think that's accurate. I'm not sure. Did that answer your question?
It does, as long as if it's something's being brought back. I just have concerns if we're creating new class specs, how we would interact with other bargaining units, and there's just a whole complex.
Oh,
If an issue developed
Yeah.
within MCR, we absolutely would be bringing that.
And we certainly would be first working with county HR. Our goal is always to work with HR in conformance with their processes for the development of positions and things of that nature. So we're not trying to cut HR out of the loop, and we're not looking for creating an adverse dynamic there. We still want to engage with HR to address questions of classification and compensation. It's just that the court case seems to give the board more authority than had previously been provided for in the past.
And just to add, I did communicate and share this information with the county council, so the county was aware that this was on our agenda today, and they know that this issue exists.
Okay, it just worries me as a trustee taking on labor negotiations, but.
I would like us not to do a board evaluation. Seems like there's been an awful lot of detail work, whatever. I, for one, don't want to do an evaluation.
Thank you for that input. There were a couple of other updates in the memo, and if you have any questions on any of those, I'm happy to answer any questions. If there's any other opinions from trustees on whether or not to do a board performance evaluation, please let me know, but I do ask for direction on that so I know whether or not I need to prepare for that.
Is there any discussion on that?
I don't think it's needed.
Is there any public comment? Okay. So at this point, there's a general board discussion. Is there any general board member discussion? Okay, seeing none. Oh, you? I'm sorry.
Seeing that I was able to benefit from the slides, I had a few questions of Doris on her recent conference.
If you don't mind, I'd like to hold that because I actually will be bringing something back to the board. I'm happy to discuss that with you offline. If you want to reach out to me, we can have a discussion about the content. Thank you.
Okay. If there's no other board member discussion, looks like there's not, we can go into closed session. The board will move to closed session for the following items. And it's Public Employees Performance Evaluation Executive Director pursuant to Government Code Section 549. And we'll return to open session after we've completed the evaluation. Yeah. Yeah. Okay, because he
I realized that my life was going to change dramatically in ways that I did not know or understand or even comprehend. I was going to have to really go to the well and become accountable and adjust to a lot of things differently.
Que queríamos era que naciera, ya, si la quiero tener, entonces ahorita lo que tenemos es aprovecharla, quererla y cuidarla lo más que se pueda.
Creo que a todos nos preocupa la primera vez que nos dicen que vamos a ser padres.
When we started the program, my daughter was about 3 months, and my daughter's 22 months now. Something I love about my child, that she's healthy, she's happy, she knows that she's cared for and loved. Those are some of the things that I wanted to make sure that she had, and she has them.
I'm happy today with my daughter. She's the greatest thing in my life, and I'm glad to wake up and see her, and everything I do it for her.
Sí, bueno, yo también vengo de una familia separada. Creo que por eso también me motiva a estar más presente con él, de quizás también estar de la forma quizás que yo no la tuve para Máximo. Y también comprender que el padre no solo es el que pone los límites y las reglas, sino que también está ahí para hablar, acompañar, regalonear, jugar, cosas lindas también, no solo ser el guía para el niño, sino que también un compañero de vida.
I was more of a elated and thankful because for 3 months I was in baby land, and when you're in baby world, you're just kind of flying by the seat of your pants and hoping you know that you're just supportive in the ways that you can be supportive.
Pero pues aquí pues ya los enseñan un poquito más cosas que uno no sabía, como cuidarla, cómo desarrollarla, cómo educarla, y pues es algo bien porque pues cosas que yo no sabía, pues ya usted nos las dijo y todo como consejos, y pues muchas cosas que se aprendieron.
Bueno, creo que por mi parte esperaba algo totalmente diferente, como un programa más frío, por decir algo, no tan cercano a la familia, sino más bien un programa de estado programado para la ayuda solamente. Y a través del programa nos hemos dado cuenta que también pasa a ser una familia con nosotros, porque nos apoya en los momentos difíciles o cuando nos hemos visto en dificultades. Siempre nos hemos podido apoyar en Gaby a través de su programa. Encuentro que ha sido fundamental el apoyo.
You know, my experience has been nothing but positive. Annette has been wonderful. She's on time. She lets me know if there's going to be any changes in the schedule.
Not only did we get the assistance with this program, but we also made a really good friend. I'm happy to call Gabby our friend.
I still feel the challenge of being a parent now in today's world is immense. I think that you need support.
Es un gran apoyo para nuevos padres, y más aún si están en nuestra situación, que somos extranjeros, que nuestra familia y amigos, como dice Carla, están en otro país, lejos. Entonces sí, viene muy bien el programa para apoyarse tanto emocional y como anímicamente, y bueno, en varios aspectos del programa que nos ayuda a seguir adelante con esta nueva aventura.
Don't be afraid to take that step. Like, don't be afraid to get help, because you might think that you know what you're doing, but it's always okay to have extra support, and don't do it alone.
Give it a try. You got nothing to lose. It's free. I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
Are you prepared? We're the Office of Emergency Services, and we're committed to providing the most up-to-date and accurate information so that you and your family can stay safe during an emergency. Part of being prepared is knowing your hazards and taking proper precautions. Visit mendoready.org. On the Know Your Hazards page, you can find hazards for where you work, where you live, and where your kids go to school. On the Plan and Prepare page, you'll find a plan template. It's important to know what you're going to do, what you're going to take with you, how you're going to communicate, where you're going to go, and how to get there.
One great way to prepare is to pack a go bag. Each member of your family should have their own go bag. Visit our website, mendoready.org, to get a list of items that should be in your go bag.
Gathering and organizing important documents before an emergency is an important part of preparedness. So visit mendoready.org today, where you can find a list of important documents that you should have ready near your go bag in case you have to evacuate.
Not every emergency requires people to evacuate. An emergency kit will have supplies for you to remain self-sufficient for 72 hours. Find a list of supplies for disaster kits on our website, mendoready.org.
A prepared community is a resilient community that will recover faster from disasters. So take some time today, visit our website, get yourself prepared so you can be Mendo ready.
Personally, I think everybody could benefit from the home visiting programs.
I think that as a parent now, I'm grateful for support more than I was before.
I filled out that form not knowing what I was doing. I am very, very grateful that I did it because it's really helping me a lot.
Bueno, creo que por mi parte esperaba algo totalmente diferente, como un programa más frío, por decir algo, no tan cercano a la familia. Y a través del programa nos hemos dado cuenta que también pasa a ser una familia con nosotros porque nos apoya en los momentos difíciles o cuando nos hemos visto en dificultades.
Well, I was a new mom and I had no experience taking care of a newborn.
There isn't like a book on how to raise a kid.
We come from like a lot of family history of, drugs, violence, alcoholism, so we didn't want our daughter to experience any of that.
The thought that a parent was supposed to be loving, nurturing, supposed to be there for their kid, provide food, shelter, joy, and going in, becoming a parent for her, I had no clue how to provide that.
Cómo pensar educarla, cómo educar a un hijo porque pues nosotros nunca, es la primera vez que íbamos a ser padres.
What I think parents should know about home visiting is that you can learn a lot of new things and tips and tricks, how to take care of the baby and what to do, and if you're, stuck in a routine and everything being monotonous, like they give you new resources and new tools how to handle parenthood.
It was nice to have them kind of guiding me, even though I was not a first-time mom. I felt like a first-time mom.
It totally blew my mind over time. So much information that I had no idea about. She was straightforward when, teaching me this stuff and answered any of my questions. Just a really positive experience.
What I think that parents could benefit with the program is just having someone here for you, especially for first-time parents. It can be very isolating and it can be very lonely, and having the home visitor changes that and it feels very good.
For me, having a home visitor is like having a second mom there.
A lot has changed. I'm definitely more knowledgeable taking care of her, and I know that anytime I need advice or help from somebody, I can just call her.
It's just that little positive nudge to, hey, I'm noticing something, let's find a way how to change it. And she's like, you know what, Amanda, let's pick you up, dust you off, And let's go over to, see about either getting your driver's license or seeing about, going to college, see if we can start something for you.
It's totally worth it. Like, even if you're on the fence at first, you don't feel like having a stranger coming in your house and teaching you about your little one, do it anyway. You get the help that you need. You get professional advice on things you may not know about your child. The fact that the program has no fees or anything, it's all totally free, is fantastic.
Yo creo que si conozco a alguien que está próxima a ser mamá, lo primero que haría sería recomendarle el programa, porque te entrega mucho apoyo, mucha información y más que nada como apoyo emocional, una guía, te da una visión diferente de cómo es ser papá aquí, quizás en este país.
Y así pues es algo, un bonito programa, porque pues es buena persona la señora y los ha atendido muy bien.
Pensé que nada más iba a ser un programa de orientación quizás para los nuevos padres, pero creo que nos llevamos una linda sorpresa porque Gaby es una persona muy cercana a nosotros, es como parte de nuestra familia, siempre ha estado dispuesta a ayudarnos y a escucharnos con nuestras dudas sobre la paternidad, y en nuestro caso, que estamos solos en este país, ha sido como de mucha ayuda.
Es un gran apoyo para nuevos padres, y más aún si están en nuestra situación, que somos extranjeros, que nuestra familia y amigos, como dice Carla, están en otro país, lejos. Entonces sí, viene muy bien el programa para apoyarse tanto emocional y como anímicamente, y bueno, en varios aspectos del programa que nos ayuda a seguir adelante con esta nueva aventura.
Te ayuda como a ver los distintos recursos que tiene la comunidad para nuevos papás, entonces creo que es de gran ayuda.
No queda mucho que agregar, pero lo veo de la misma forma.
Que hemos aprendido algunas cosas aquí y pues los han ayudado, como este programa los ha ayudado para seguir creciendo a la bebé, como con buenos consejos y así.
Sí, y creo que también ha sido muy importante el tema de apoyarnos con el libro y saber qué actividades hacer con Máximo de acuerdo a su edad, cómo estimularlo, cómo cuidarlo de los peligros de la casa, como cosas que uno como papá nuevo no conoce, claro.
Pues a mí me gustaría que lo siguiéramos visitando aquí en la biblioteca de Covelo. Está tranquilo y muy bonito aquí.
Cuando no nos podemos reunir, nos comunicamos por Zoom o una llamada telefónica o por texto.
Donde nos visite, porque ha sido nuestra casa, a veces nosotros vamos a Wellits y puede ser en el parque. Gaby llega, como hacemos un resumen de cómo ha ido nuestra semana o qué hemos hecho de nuevo, cómo va el trabajo. Luego hacemos las actividades del libro. Vemos si podemos hacer un juguetito nuevo para Máximo, a veces ella lo evalúa, cómo está su sentido motriz, qué ha aprendido de nuevo, nuevas palabras, y jugamos un ratito y conversamos.
A mí personalmente también me ayudó mucho a obtener mi licencia a conducir, que era un objetivo que teníamos en cuanto a la familia, sí, para poder estar tranquilos, así que encuentro que ha sido fundamental el apoyo.
El objetivo del programa es que las familias estén bien, y que las familias estén bien significa niños felices, niños sanos, y eso en un futuro es adultos sanos y un mundo mejor. Entonces está bueno.
She has made me feel like I'm important and I can go at my own pace, and that's all you need sometimes when you're feeling like you got nobody.
It was helpful to have somebody there kind of holding my hand and guiding me and letting me know this is kind of the normal. It felt like I was becoming a new mom, so it was very interesting and helpful, very, very helpful.
You know, there was that self-conscious part of me, like, will I be accepted even though I'm not perfect?
What I like the most is that she really listens.
The support that she gives me is special because she does it with love, and it's just natural, you know. That's all I could say. It just feels like somebody that I've known since I was little.
You know, I said to Jeanette, Jeanette, you're supposed to be with me for 5 years. Jeanette said, yeah, I know, I'm going to be with you guys for 5 years. That's when I said, well, I guess I can trust her. She's going to be with us for 5 years.
Yo creo que quizás pasó como a la segunda visita o algo así, como que ya nos presentamos formalmente. Y luego ya creo que en la segunda visita estaba como todo más tranquilo, como muy, como que el ambiente era muy familiar. Entonces yo me sentí muy cómoda.
Felt like she cared for Sparrow too, and Sparrow really enjoyed it. Yeah, she knew when Gabby came we were going to be making something or learning something, and she'd instantly start digging through Gabby's bags to find out what activity we were going to do.
Not only did we get the assistance with this program, but we also made a really good friend. I'm happy to call Gabby our friend.
I think the relationship that we've built has been just, she's a part of the family.
Are you prepared? We're the Office of Emergency Services, and we're committed to providing the most up-to-date and accurate information so that you and your family can stay safe during an emergency. Visit MendoReady.org. It's our one-stop shop for emergency information. You can sign up for emergency alerts, find your pre-established evacuation zone on our current emergencies map, and find hazard and preparedness information.
Imagine you're faced with a disaster such as a wildfire, and you're ordered to evacuate. I'll bet you wish you had more time in that moment. Now's your chance to buy yourself that time. Sign up for Nixle and Mendo Alerts on our website, MendoReady.org. Do it today.
If you want your family to be as resilient as possible, it's important to take some time today and visit MendoReady.org, where you can look up your pre-established evacuation zones on our current emergencies map. You can also find important tools to help maintain your situational awareness, such as the Alert California wildfire cameras and the Caltrans road conditions cameras. We hope you'll take some time today to prepare so that your family can be Mendo ready. Thank you.
When I first realized that I was going to be a parent, I was super scared. After 2 or 3 weeks of meeting in the home visiting program, I was totally comfortable with the fact that I was going to have a baby. Yes, I was still scared, but at the same time, I felt like I had some sense of strength behind me.
If I didn't have those resources that Jeanette provided me, I think it would be harder now.
I got into the program and I realized, like, oh, this is nice. And now look at me, I work at a family resource center with parents and families, all this stuff.
I'm so grateful that I got the opportunity to meet my home visitor, because without her, I think that I would be 10 steps behind from where I'm at right now.
Pero pues aquí pues ya los enseñan un poquito más cosas que uno no sabía. cómo cuidarla, cómo desarrollarla, cómo educarla, y pues es algo bien porque pues cosas que yo no sabía, pues ya usted nos las dijo y todo como consejos, y pues muchas cosas que se aprendieron.
I don't know what's normal for a 22-month-old baby or an 18-month-old baby, you know. When we get together, we usually discuss and get some progress made with the baby. It makes me feel comfortable, and I associate my parenting with her, my home visitor, telling me, yeah, this is going great.
So it's nice to know where they're at, what stage they're at for every parent, and also to give, again, your children that head start in education.
If I had any questions with her, just call her up on the phone. You know, it was very relatable, very personal. And, you know, with her getting to know my kids, you know, she got to kind of help guide me along the way. I mean, there were so many cool things that I've learned.
I went from a very like rough type of life. I was homeless, and she was able to help me get into school, and I actually have enough credits to graduate with the business degree right now.
I think I really want to mention just that I'm grateful that I took advantage, because it's something that has put me in touch with my child, or closer to my child and her development.
I want other people and parents to know that the home visiting is not something that you should be afraid of. It's actually something that is needed.
You know, because she's not just here for her, she's here to help with all of it. She helped me create a safe space where I feel comfortable enough to ask for help.
Don't be afraid to take that step. Like, don't be afraid to get help. It's always okay to have extra support.
I would say, give it a try. You got nothing to lose. It's free. There's some perks, you know. They've got some great resources.
Personally, I think everybody could benefit from the home visiting programs.
I realized that my life was going to change dramatically in ways that I did not know or understand or even comprehend. I was going to have to really go to the well and become accountable and adjust to a lot of things differently.
Que queríamos era que naciera, ya, sí, ya quiero tener, entonces ahorita lo que tenemos es aprovecharla, quererla y cuidarla lo más que se pueda.
Creo que a todos nos preocupa la primera vez que nos dicen que vamos a ser padres.
When we started the program, my daughter was about 3 months.
At 11:45, I'd like to report out.
Yep, we're good.
From our closed session, and the executive director's evaluation has been given. Thank you. And that is, meeting is adjourned until next month. Okay.
And I will not.